Bloomberg's got a real cottage industry on that. But the trade here nobody's talking about is off of COVID. Dennis Gartman up 72% in gold when you hedge it against Japanese yen. To me, it's not NVIDIA, but stupid gold is up 72% off the pandemic gloom.
I love Tony Dwyer's honesty. He's like, I don't get it.
Yeah.
Because people, and I agree, because I was looking at what was driving this. I'm thinking, okay, does this mean inflation? Is this like an inflation call? Is this a slower growth call? And in reality, some people were saying it's because if you get less from your cash, you might be less inclined to invest in cash with interest-producing revenues versus, you're looking at me like I'm nuts, but it's true. I mean, what rationale can people come around to explain this move?
Okay.
24 years old in a meeting with John Templeton.
Yeah, exactly.
I was 24 once. I know you don't believe it.
Thank you for trying.
Take us telling stories. Carry on, please.
24, I'm in a meeting with John Templeton, and he channeled Tony Dwyer. Sir John Templeton said, gold, I don't get it. Which is,
You've got to be honest,
Tom. Good company. Dwyer, Templeton, I mean, it's good company. It's all there is to it. We're in good company right now on FX. George Saravelos is global head of FX research at Deutsche Bank. George, throughout your note, there's this speed towards very weak inflation and abrupt disinflation. How do we play that in foreign exchange?
So I think, Tom, next year it's all going to be about these policy gaps. Which central bank is going to cut first and which one is going to lag, or is it all going to be symmetric? And the way I think we're being set up for next year is that the ECB is most likely to go first. If we look at the most recent inflation data, I would argue the ECB should actually be cutting next week. Core inflation over the last 3 months is running below 1%. So we're not that far away from having to start thinking about deflation risks when we're discussing Europe. And of course, the economy is also at best in stagnation. So I would argue the market is right to price more ECB easing, but perhaps versus the US is getting quite ahead of itself.
George, you've got some aggressive calls on both central banks now then. You've got a call on the Federal Reserve, you and a team. I think 170 basis points, 175 basis points of cuts starting in June next year. Now, George, there's a range of forecasts, as you know, for next year, but that's certainly not consensus. Can you explain to us all why you think we start in June but go a whole lot deeper than a lot of people think?
Well, I think, John, that goes back to the recession versus soft landing debate. And now, if you look at what the market's pricing at the moment, we have Fed funds going to around reasonable estimates of neutral, slightly above 3%. So the market is perfectly priced for a soft landing, so to speak. So I think if we're looking at next year, the strongest view I would probably have is this bond equity correlation, which has been very positive. So you've had higher bond prices and higher equities at the same time. That's very unlikely to last because you're either into a soft landing and therefore you can't price lower Fed funds anymore. Risk can continue going well. But if you do go into recession, then you can most certainly price more cuts, but it's not going to be possible for equities to still rally. So the last 3-4 months have been great from an asset perspective because you've had this bonds and equities going up at the same time. I think that's going to be very difficult to repeat itself for next year.
That's on the U.S. side. I want to just get you to elaborate a little bit when you're talking about your belief that the ECB should cut next week, that you think that the Eurozone is facing deflation and that risk is rising. What do you think will be the follow-on response if the ECB goes ahead and does that? Do you think that they could then engineer a soft landing, or do you think that they could just avoid the depths of a pretty significant downturn that you think hasn't been fully recognized?
So I think it's important to distinguish between growth and inflation. And in fact, if I look at Europe, I would say it's the perfect definition of a soft landing, because what you have is growth has slowed down, and at the moment it's around 0. So we're debating maybe we get 1 or 2 quarters of negative GDP. But as long as the ECB cuts, and I need to be careful in what I say, I think they should be cutting next week. I don't think they will. I think it's more likely precisely because they were late on the way in, so to speak, they'll be late on the way out. But as long as the ECB, say, cuts by March, April, I think actually Europe's going to be in a relatively okay place where the economy soft lands and inflation comes back down to 2% or potentially below. But that's actually a pretty good outcome. It's also quite a negative outcome for the exchange rate. But given how quickly inflation's coming down, probably a weaker euro is not a bad thing for Europe at the moment.
George, over the weekend was a lot of zeitgeist hope and prayer of a strong yen off of some form of policy change in Japan. a way for people to make big, big, big figures fast. Do you buy it?
So there's two ways to get a strong yen. One is that the Bank of Japan finally starts a proper hiking cycle. And what I mean by that is they say they're going to start hiking every meeting. That looks pretty unlikely, especially as the rest of the world is moving into an easing cycle. So I'd probably say that's the least likely outcome. But if you are in an environment where the other central banks are starting to cut because inflation has come down, then you can get yen strength because it will be the outlier, so to speak, on the way out as it was on the way in. So I'd be much more inclined to think about yen strength from the global perspective rather than the domestic Japanese perspective.
Dear Christine, George thinks you will cut next week. What do you think, George? No, don't worry. It's not going to be the headline. George Saravelis at Deutsche Bank. George, thank you. There's a difference between, I guess, will and should, and
yes.
Ultimately DB think they could and should cut next week, but won't. Ultimately, that'll come next year.
This is the should and could and maybe part of the show.
But the fact that he said that even if they do it by March or April, they're still in line to orchestrate some sort of soft landing, which raises this question, which economy is going to outperform? Europe or the U.S.? Everyone just assumes it's going to be the U.S. because of technology.
Was just going back and forth with Dr. Ilarian, and I was reminding him of the Bank of Japan abject failure somewhere in the middle 2000s where they tried to raise rates and had to go, oops.
When we say
it's the same thing here. Cut
outperform,
rates, oops.
absolute terms or relative to expectations?
It's a good question. Relative to expectations would affect market positioning, maybe. In absolute terms, I'm guessing that's going to be tough, given the tech outperformance in the U.S.
Because relative to expectations, the economy, that's already happening, isn't it? The surprise indices.
Yes,
you look at what's happening
correct.
with the U.S., great disappointment relative to where we were maybe just a few months ago in the States.
But this is what I think a lot of people have attributed to why the euro has outperformed, at least in the month of November, why it did rise as much as it did versus the dollar, even though there was this everything rally in the United States. It wasn't just a sort of a rate differential, but it was also the European economic data was coming in better than expected. The disinflation was happening faster than expected. You know, going into next year, how much is this sort of set up to repeat, given what people's expectations are?
I don't have a strong opinion. I just.
But?
No, I just think November's a shock, and we're starting right in on a November continuing here.
Yeah.
And to me, that's the heart of the matter.
I saw someone write this weekend that I think the outlooks for December, looking out 12 months, are basically just taking November and extrapolating current trends out. Right, that's kind of
What
like
else
the
can
outlook.
they do?
And then
I feel for that.
We reset in Q1, which is what we always seem to do
How else can we do this?
every year. Equities negative on the S&P from New York City. A beautiful morning in New York City.
Oh.
Good morning.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
all about the human condition. You know, more people are living longer. You know, we've cut childhood death in half. Climate is this negative thing that's slowing down that progress. And so in mitigation, you know, we want to make sure the temperature doesn't get too high. And then in adaptation, we want to make sure that the ill effects, that whatever we can't mitigate, that it doesn't reverse this incredible rate of human improvement.
That was Bill Gates there, the co-chair of the Bill and Melinda Gates Foundation, speaking with Bloomberg's Francine Lacqua on the sidelines of COP28. It's always on the sidelines. It's never kind of at the event. You notice that? It's always on, what does that mean?
It means
on the sidelines.
It's not necessarily
not
on the panel.
It's on the sidelines.
Yeah, exactly.
Great piece in the Financial Times earlier on, TK. I know you've read this as well. The real impact of the ESG backlash in the Financial Times this morning.
This is Brooke and Tim, the duo over at the FT, Brooke Masters, really walking through it. They feature Larry Fink and BlackRock a lot on it, but it's fascinating to me to see the gathering of the great, the good, and the worthy in Dubai wrapped around what does it mean for climate finance. And at the minimum, it's in a massive turmoil right now, whatever anybody's view is.
Don't you get the feeling that there is a great majority, I would say not a great majority, a good slice of this electorate right now, Tom, in the United States, that look at what is happening in Dubai and see this gathering of what they see as the establishment, as elite liberals telling them how to live their lives after landing in private jets in the Middle East and flying thousands of miles to tell us all to consume less oil and fossil fuels.
Yeah, G6 is the Dierks Bentley song. What I would suggest is, and there's one chart in the FT article, the difference between Europe and America.
Oh,
like
massive,
we all know that, but massive.
Vast,
no, you're
huge,
right. Massive
huge.
is the operative word. It's hugely so. I was stunned at the ESG investment impulse versus in America.
There's a new tone, though, I would say, and it's moving from the sort of highfalutin dreams and hopes and messaging and going more to the reality of it. And I think that that is sort of what I felt a little bit more from the rhetoric and, frankly, some of the pledges, particularly from the oil-producing nations, OPEC plus, less so the oil-producing nation of the United States, ironically, that's been accelerating production.
Crude production, Tom, 13 million barrels plus a day
in
the United States of America.
And what will that be a campaign issue? I mean, it's going to be interesting to see, and particularly
We
what
just
the
don't
price
talk
of oil
about it.
does. We don't.
Hey,
Yeah, you know.
seems to be the approach at the moment.
Talk about it. Right now, we are going to look at the climate affairs of Dubai, and this with the World Bank in transition. From David Malpass over to Mr. Ragan, what's so important here is his corporate work with Nestle and on MasterCard and then General Electric. With a conversation with the president of the World Bank, our Jen Zabajaja in Dubai. Jen?
Yeah, thanks so much, Tom. Ajay, Tom was just giving you a really great intro there about how your previous career, now you're at the World Bank. And let's just talk in the first few months of your role, you've made climate finance a priority. I mean, can you talk to us about where you've seen progress and whether you think this is really a turning point for this discussion?
You know, I think it's very important because the reality is that we've had the hottest year on record. We're aiming for another hot year. Clearly, this has to change. And you can't make climate and fight the climate issue without money coming to work on it. So it's one of the most important things. When I traveled around the world, I picked up the impression that dealing with poverty cannot be by itself. You have to deal with climate, pandemics, fragility. These are all intertwined crises. That's why we changed our mission to include livable planet in addition to eradicating poverty. So this is what we're on. And what I'm trying to do here to show you the progress is to make a commitment that we will get to 45% of our financing annually will go to climate by 2025, 2 years from now, not 10 years from today.
Right.
That's $40 billion a year working on climate finance.
How do you do that? How do you adjust your balance sheet to ensure that?
Yeah, well, the good news is we're also raising capital along the way, thanks to this whole capital adequacy framework that the G20 got us going with. And we're also doing things like looking at whether we can securitize parts of our balance sheet, existing balance sheet, free up some capital, and then partnerships. So you don't really do all that financing yourself. You can also get partnerships going. You know, I have great partners with the other multilateral banks, AIIB, EIB, EBRD. These are all people who work with us. So there's multiple ways to go at this. But at the end of the day, the much bigger issue here is, even if I do all that, even if the other multilateral banks do what they can, even if governments do all they can, you do need the private sector. You're going to need their ingenuity and technology and numbers.
Right, and that's what you've been spending the past few days talking a lot with the private sector. This is your first COP.
Yes.
Can you talk to us about, I mean, give us a sense of what it's like in the room, where there's consensus and where there's still gaps within the private sector and the collaboration between
That's a great question. So the private sector issue is the private sector now knows that solar and wind power per unit is cheaper than fossil fuel. That's proven with scale and technology. They know that it takes longer sometimes as a gestation period, and they know they may have some higher capex up front because they got to build grids, and you can't just build the installed capacity, right? So they understand that. So why is it then that they aren't burning down the doors of countries to go do this? It's for 2 or 3 reasons. One is, does the country have the capacity to absorb this kind of projects coming in? Can they connect the grids up? Can they do all that?
Right.
But second, and much more critical, is the 2 kinds of risks that private sector investors don't like, which they don't understand. They don't understand political risk, and they don't understand foreign exchange risk in the emerging markets. Now, political risk we can help with. We have this institution called MIGA, our guarantee agency. We've now got approval to use that for every multilateral development bank. They can use our back office to issue guarantees. This does political risk guarantees and then lays them off in the reinsurance market. We need to scale that. It's the FX risk that's the much harder
Well,
one.
how do you get around that? I mean, because that's not going away in a lot of emerging
No,
markets.
so in fact, people keep talking about local currency markets as the way to do it. The reality is developing a local currency market of the right depth and width to be able to do this well can take 5, 10 years. We don't really have 5 or 10 years.
Right.
So I think we have to find instruments like, could we do some local currency bond issuance that we subsidize the difference in cost through our balance sheet or our concessional financing? Can we do things with others where there's an institution called TCX, which was created to help take some of the FX risk in these markets? Can we scale them up? And so on and so forth. Can we do creative swaps where using our rating we get at a lower price than what the country would? Hard. FX risk is the hardest one.
Yeah, I mean, so then, Ajay, when we talk about the progress then at the end of COP28, your first COP, I mean, what does that look like for you? What is it that you're shooting for? Because there have been a number of initiatives and pledges.
Yes.
Of course, the World Bank has been a part of some of those. I mean,
Yes.
what then does progress look like in the next few days?
So I've got 5 very clear things I'm measuring on what we're doing. And the first one was getting that 45% of financing that we talked about. In that, 50% for mitigation, 50% for adaptation. So we don't only do emission avoidance, we also care about adapting and resilient infrastructure in the global south. I think that's very important. The second big one is methane. Methane is 80 times more toxic than carbon dioxide, but it only gets 2% of climate financing. So what we're doing is we've got actual projects on the ground on rice paddy cultivation, livestock management, and waste management. We're scaling those and saying we're going to get to 15 countries in 18 months, and over the course of these projects, take out 10 million tons of methane from the system. Third one is Africa. 600 million people in Africa don't have access to electricity.
Right.
We've got a project approved by our board, 5 billion of financing from IDA, our lowest price guarantee, kind of the cheapest fund location, 10 billion through governments and private sector. We're going to connect 100 million people in 7 years to power, solar power, including the grids that need to be existing to make this happen at scale. A fourth one is voluntary carbon markets. So I think the only way you transfer resources at scale from the developed world to the developing world for what the developing world deserves to be paid for, which is forests and natural resources, is voluntary carbon markets.
But there's a lot of criticism about carbon markets.
Yes, there is, because people felt that the credits that were coming weren't genuine credits. So you just picked on exactly the topic that's really important. Verifiable, genuine credits of integrity are what determine whether these markets will work. So what I'm doing is I'm not doing a carbon market where I'm not involved. I'm doing carbon markets with projects where the World Bank is doing a forestry project in a country.
Right.
So we're starting with 4, going to 15 by the end of next year. We think these countries will generate 24 million credits next year itself, and 125 over 5 or 6 years. I'm certifying the environmental integrity through a jurisdictional audit, and I'm also certifying the social integrity, that most of the money they earn will go to the communities and the indigenous people in that area.
Right.
I think if you do things like that, and you do them with consistency, you will create the right kind of carbon markets for tomorrow.
Right.
Today, you're only getting $5 a credit.
Right. And we still, yes, but still a lot to go. But glad to have you here, Bloomberg. Ajay Banga with the World Bank. Ajay, thank you so much for your time. Thanks for joining us.
Thank you.
Here.
Thanks very much.
John, back to you.
Hey, Jen, thank you. We've got to go. Jennifer Tabazaja there and Ajay Banga, the World Bank president. Coming up on this programme, on the market, Dan Morris of BNP Paribas. In the next hour, Helene Becker, airlines analyst on a potential tie-up here in America, and the busiest day ever in American airports.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AfDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges next.
It was going to keep bringing World Cup. This is a three.
As the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
The top names in global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
Data has turned, right? You're starting to see soft data, hard data, inflation data, all surprising to the downside.
For the US economy next year, we think that growth is going to stall in the second half. It's not a particularly great outlook.
I'm more worried about inflation coming back and a shock to the inflation trajectory than I am to the growth side of things.
The question into 2024 will be, can we stop the cooling before the economy tips into contraction?
Even though we have a recessionary call in the first half of the year, I think that's an optimistic scenario for the economy. It allows a reset.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
5 weeks of gains on the S&P 500, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Bramberts. I'm Jonathan Ferro. Your equity market this morning, session lows and down 1/3% on the S&P. Forget this morning. Let's talk about Friday. Monster move in the bond market. On the week, 41 basis points lower on a 2-year maturity. TK, even with a bit of pushback from Chairman Powell.
I like what you said in the previous hour. It continues this morning. Yeah, there's a little bit of a pushback in all that, but a 10-year real yield below 2%, right now 2.02%. It goes to my research note this morning. Carl Weinberg at High Frequency Economics, a blistering note to Europe, as George Saravelis just talked about. Deflation is possible.
The conclusion on the street right now for so many people is the Fed is done. That weekly move on a 2-year last week, Lisa, the biggest weekly move going back to March. Back in March, the conclusion was always the Fed is done. But also, it was the Fed is done for all the wrong reasons. They've broken something. Here we are about 6, 7, 8, 9, 10 months later, and we're talking about the Federal Reserve being done for all the right reasons.
And not only just done, right, with rate hikes, but actively cutting rates by March. The market is pricing in a better chance than not that they will be actively cutting rates, even though they're not expecting some sort of significant downturn, which raises a couple of questions. Is the global disinflation wave the same in the U.S. as it is, say, in Europe? And also, can we get that? Or are we going to see a rollover? Or can you just chillax, like we heard earlier, and lean into this incredible rally and just say, hey, I'm going to take the rest of the year off?
Tell you what, so chill.
Oh, yeah.
So
chill.
It's so chill. This conversation about rate cuts is happening on a week. We're looking for this in a payrolls report. 180,000 is the median estimate in our survey. Tom, unemployment expected to stick at 3.9%. You've got a chairman saying we're well into restrictive territory. You've got a market pricing rate cuts. You've got a labour market that could still see 180,000 this Friday.
This is the second time you brought this up, and we haven't sat on it. Let's sit on it right now. I'm going to look at a 3-month moving average of non-farm payrolls. We're nowhere near labor slowdown, but there's a school of thought out there, I'd say led by David Kelly at J.P. Morgan, who made clear we could get there quickly. You get to a 3-month moving average non-farm payrolls under 100,000, or the negative non-farm payrolls that Dr. Kelly's talking about. That will change things fast.
Well, here's a company that is going negative. I don't know about the broader economy. Spotify, Lisa, cutting 17% of jobs. Leadership over at Spotify, looking for the streamer to be a whole lot leaner. That stock is positive 0.7%.
Something like 1,500 people. They're also going to optimize their office space footprint, I believe. Basically trying to trim costs by reducing the amount of space they got to pay for at a time when they otherwise were facing some negative expectations. I mean, really, we have to emphasize this is coming with revenues that clearly were challenged.
Without a doubt. I think it always amazes me, at least, that to cut costs, it costs a lot of money, at least up front. Tom severances, it's not cheap. Cutting office space, getting away from those things, costs money. So the new outlook for them, they've put a number on it, Tom. 4Q operating loss between 93 to 108 million. They had previously seen a profit of 37.
2 observations. They went out front with a 17% job cuts off of 6% and 2% previously. I think 6 plus 2 plus 17. Do the math. That's 25% jobs cut. They put it up front. GM buries it. I mean, six headlines down, GM's talking about $2 billion of cost cuts. There's no difference. They're cutting costs in a new world.
I'm pleased you're bringing up GM because I'm still a little bit confused as to what happened last week. And I became more confused once you hear more from Ford. So GM is saying off the back of the labour market contract, the labour contract they signed with UAW, the additional cost of $575 per vehicle. And Ford are coming out and saying it's upwards of 900. Now, forgive the pun, you can drive an F-150 through that range. That is massive, Bramo. That's massive. So have they been very, very transparent?
He's been here for 2 or 3 years, and he knows what an F-150 is.
2 or 3
This is
years.
year 8.
Yeah, I know. But I agree with you. And there's some real questions here about the transparency around how these costs are to be distributed.
Let's move on and get the scores. Why do you always forget how long I've lived here for?
I don't know.
Come on. It's been a blast, TK. Equities on the S&P, down 0.4% on the S&P 500. Yields are positive by a couple of basis points, up 5, but still down here in the 420s. Lisa, 424.53 on a 10-year.
Today is basically just the beginning of a drumbeat to Friday with the jobs report, the non-farm jobs report coming out. Then we got October JOLTS report tomorrow, Wednesday ADP, Thursday initial jobless claims, Friday's jobs report. To me, the bigger question is what will the market respond more to, an upside surprise or a downside surprise? Meanwhile, central banks have gone quiet, except for 9 a.m. We're going to hear from ECB President Christine Lagarde. But at the Fed, they're quiet ahead of next week's meeting. We do get the Bank of England Financial Stability Report. I am focused on the Bank of Canada. Their rate decision is on Wednesday. It's interesting in an otherwise quiet week to see whether they signal, they lean into the idea of rate cuts as a result of disinflation, even without some sort of economic weakness. And consumer spending, we get to read ISM services tomorrow, Thursday change in household net worth for the U.S. as well as consumer credit, and Friday the University of Michigan sentiment survey. I want to see whether we see an ongoing uptick in the economic surprise index for the U.S. We've recently seen that shift a little bit. If it does, do people start to think, okay, well, maybe we are due for some sort of reacceleration in inflation that's being priced out?
Don't you think, and this is going to sound rude, that second-tier central banks have a little bit more flexibility than top-tier central banks? I mean, for the record, I'd put the Bank of England in there as well as a second-tier central bank. But
you know, what's interesting to me is that over the past couple of months, the Bank of Canada has actually been a front runner in terms of signaling how the mood is going to shift in other central banks.
Perhaps longer, yeah.
And there is a question, perhaps longer. So there is a question now. Is this sort of the backdrop of inflation diverging meaningfully between these different regions in a way where you can't necessarily look to these other central banks as tea leaves? I don't know the answer. I still think it's interesting to watch because there's not really any other central bank stuff to watch.
I'm on board.
Go for it.
Are we upsetting Canadians again this morning?
I've already gotten several messages.
It's a team effort.
I've gotten messages.
Okay. Dan Morris joins us now, Chief Market Strategist at BNP
not from
Paribas
Canada.
Asset Management. I hope not. And I hope he's still there. Dan's still there. Dan, let's get to it in the equity market. Massive move in stocks over the last month or so. Given the repositioning, given the rally, is the path of least resistance still for this rally to continue?
I think if we think, I guess from here, the two scenarios most likely, or I guess three scenarios ahead of us. So one, status quo, things don't change with this kind of perfect soft landing. That'd be nice. How likely we think that is. Alternatively, then, as Lisa's mentioned, it's either you get a blowout on non-farm payrolls or it's weak, and then how do the markets react? And in those scenarios, it's probably more risk to equities because if we get a weak number and instead of a soft landing, we start worrying about a recession, then equities aren't going to look so good. If conversely it's a very strong number, then at least some of this rally in real rates has got to come out, and that's going to hurt as well. So it does seem that the risk at this point seems more concentrated in equities.
Dan Morris, my arch-COVID theme has been corporations will adapt. Right now, I think there's a disbelief that they will not adapt into 2024. I don't believe it. With the tentacles of BNP Paribas, how do you see how corporations will adapt to the new 2024?
Well, the thing I'd probably highlight in terms of the adaptability, I certainly agree, particularly when we talk about U.S. corporations, they will. Just go back to what happened during lockdowns. You had 20 million people lose their jobs during lockdowns. Now we know employment's higher than it was before. So you've seen that adaptability in extreme form then. So certainly they're going to try to anticipate what's going to happen. Our view still is for a soft landing. And I think that's the challenge for equity assets in particular is being able to assess what's going to be a slowing growth environment, even if it's still, in the end, a positive growth number. That's tricky for equities. Either you want things to be accelerating, that's easy, or even a recession is easy because we know how that works. This slowing growth is harder, and I think we're going to see those swings in sentiment as the market goes between a recession or it's just the Fed cutting sooner.
Dan, I want to just develop what you said a little bit more, that either way, equities face a pretty big risk on Friday. Are you basically saying that right now, equities are kind of priced to perfection in this Goldilocks sphere that can't continue, and that Friday is very well the catalyst to that, regardless of whether it's an upside or downside surprise?
Well, I guess you're looking what the next data point, big enough data point, is going to be that's going to upset the perception the market seems to be reflecting now. So we've got, basically a growth number we've already had so far, the ISM and manufacturing, which was weak, so that's feeding into the slowdown. But if we then get another weak growth number, then that's the risk that it goes towards a recession scenario. So that's the obvious one. We got to wait a while till we get more inflation data. So this is going to be the next key growth number, though at the same time, we want to remember labor market data is lagging. So how much this really tells us about what's going to happen over the next 3 months is questionable, but that doesn't necessarily mean the market won't react to it.
What do you think is more disruptive potentially to equities, an upside surprise or a downside surprise?
You know, I think upside at this, well, if we get a stronger growth number and some of this rally in rates, particularly in real rates, reverses, you know, I think that's certainly a reasonable scenario, but you wonder how far is that going to go? You know, we've had a big rally, certainly in NASDAQ. That comes off a bit, but you're still obviously done very, very well this year. I think the bigger risk is to the downside if we start worrying about that recession scenario, because then the bottom probably is way slower than where we are right now, particularly after the rally.
Hey, Dan, it's good to hear from you. Dan Morris there of BNP Paribas. A slightly constructive view, nuanced, but constructive view going into next year. Canadians write in, here's one. Bramo could give a relevance of Canadian economic indicators presentation on the Bloomberg of the Seas cruise while Ferro plans the Italian shore excursion. Is this cruise ever happening?
I think that people are planning it for us.
Can I just say, we've been laughing about cruise lines all year. And a cruise liner is the #3 top performing stock on the S&P 500.
Yeah, it is.
This year.
Plus, Royal something, I think, just
Bloomberg
put
of
it
the
in.
Seas.
Somebody just dunked a new boat in the water, which is even bigger than the one you were on last sojourn.
Crazy.
It's like 42 floors tall.
Royal Caribbean Cruises up 124% this year.
You know, it's like on the edge of NVIDIA. Canada, the #1 person I want to talk about in Canada is Jean Boivin at BlackRock. I think is just the guy that I'd really, and David Rosenberg, of course.
Would be so upset.
David Rosenberg in Toronto as well. And besides the fact, can the Bank of Canada bring back the Montreal Canadiens? The difference there is a goods producing mining segment. It's different than America. And the other one I'd really focus on is a productivity differential. Canada, for generations, has had a productivity less efficient and surprisingly diminished from the United States efficiency. And those would be the two overlays that would be the difference.
Housing market really different as well, yeah.
Way different.
Big difference there too. If you're just joining us, welcome to the program. Here are the scores on the S&P 500.
Scores.
5 weeks of gains on the S&P coming into this week. We're pulling back just a touch. We're negative 0.4%. Yields are higher by 6 basis points. TK 425.49, but last week a whole lot lower across the curve.
Did you watch the Tots highlights?
I watched no football at all.
What is this about? This is
absolutely
this
no
is
football.
You?
I watched the Tots highlights.
Yeah, they're great.
They were really good.
Matt, thank you for emailing in or tweet, whatever. But you know, it was really. Mohammed mentioned it.
And Casa Bramo is all about Liverpool.
What do you think
TK,
of their kit? The kit leases their uniform.
They did really well too.
They get this
but you know,
kit
Man
that's
City,
like this
they were
pukey
versus
brown.
Man City, so you're kind of rooting for Tottenham because everybody hates
You watched
Man
2
City.
big games over the weekend.
I didn't watch them. I watched the highlights. I watched them the way that Tom King watches them. Let's just be very honest.
What you're saying is
I'm not
you
going to
didn't
try to
like
pretend.
you didn't like the grey jerseys of.
They're not grey. They're like the pukey mauve kind of brown. You know, I don't know. You know,
would you
come
like
on.
Daniel Levy's email address so you can?
No, I think
so
you
can
should
tell it?
re-interview the guy. That was a hugely successful interview.
We'd
And
like
you
to
lead
talk
by
about your
going,
pukey
"It's Kit."
moth-coloured jersey. Do you want to come on and have a conversation?
They look like they're you know.
That's the
They
pitch.
look like a a Dior roadshow in Paris or something.
Yes, John. When can I join?
When can I talk about that?
I'll get on the jet to New York. Okay. AMH is coming up shortly. Anne-Marie down in Washington, D.C. Just a bit of
understands
a
that
bit of a
mauve.
shift in the emphasis from this administration over the weekend regarding Israel, TK. Some strong words from the Vice
A
President.
huge shift. No, I wouldn't say a bit of a shift. I'd say huge shift in the news flow on Gaza.
That conversation, TK, is just around the corner. Your cross-asset price action looks like this. Stocks are pulling back. It's a reversal of last week. Last week, stocks up. This morning, stocks down. Last week, yields down. This morning, yields up. 6 basis points on a 10-year, 424.49. On a 2-year this morning, up 7. Back in the 460s. On a 2-year, 461. From New York City this morning, good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From New York City,
From London and Sydney.
from Washington,
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Tuesday, a special episode of Bloomberg Surveillance live from Apollo's headquarters. Join Tom, John, and Lisa for exclusive interviews with top leaders in finance, including Apollo's Mark Rowan and Jim Zelter, about the state of private markets, recession risk in the new year, and deal-making amid high interest rates. It's all happening December 5th, starting at 6 a.m. Eastern on Bloomberg. Context changes everything.
As Israel defends itself, it matters how. The United States is unequivocal. International humanitarian law must be respected. Too many innocent Palestinians have been killed. Frankly, the scale of civilian suffering and the images and videos coming from Gaza are devastating.
That was the Vice President Kamala Harris speaking at COP28 over the weekend. That first line, TK, really set it up. As Israel defends itself, it matters how. It's a shift in emphasis over the weekend.
A little shift in emphasis, but a real emphasis around the geography of moving north and south down 24 miles of coastline. We had video earlier, and I actually looked on the map. Okay, where's the video from? 4 miles from Rafah in the gate to Egypt, if you will. That horrific video we showed a previous hour. Good morning on Bloomberg Radio. We're showing it on TV. That was, Lisa, 4.4 miles from that exit point into Egypt.
There was a lot of discussion around what strategic defeat meant, right? And I think it goes to this question of how, and also the imagery that's coming out, right? What is the devastation needed for Israel to achieve its goal? And how much is that going to be increasingly important for the U.S. administration and other allies? And how do you achieve that? There are increasing questions around what the influence of the U.S. is internally with Israel at a time where there's a lot of disagreement within Israel, not about the goal, but about how to get there and about what necessarily takes the place afterwards.
And tangential to this, besides American Navy and other forces at risk, was in the Red Sea over the weekend. Yemeni, I'm going to say drones, I'm speaking amateurly. On TV, we're showing the Khan Yunis Gaza Strip devastation for those on radio, but in the Red Sea, the United States of America is shooting, I believe, Yemeni drones out of thin air. I mean, you don't do that with a 12-gauge shotgun. There's a lot going on there.
Elise is picking up on another shift, Tom, and it's important. The United States and this administration want to talk about the end game here. What's next? We know the objective of the Israeli government, but it's the end game. And what you're hearing from Harris over the weekend is asking for significant resources from the international community to rebuild Gaza after all of this. And also, Tom, to try and strengthen the Palestinian Authority as well. And to get the support of the Palestinian people for the Palestinian Authority to lead the way here, Tom, and try and get some legitimacy from the international community.
I think you're dead on
These
here.
are going to be big pushes.
And what we heard from the Vice President, the end game, and also a human rights-centric approach by a large part of the American force looking at this. Joining us now for a briefing on this, our Bloomberg Washington correspondent, Anne-Marie Horton. Anne-Marie, to John's point, I think he nailed it. There's almost two separate conversations going on. Enlighten us on what the Israeli conversation is this morning that Washington needs to listen to. What are the Israelis saying?
Well, we've heard a lot from Israeli officials over the weekend as well. And anytime you try to talk about the next day after, or even some New York Times reporting about intelligence failures, they do not want to discuss it right now as they are in the midst of a war. They say what the international community does not recognize, that we are still in the aftermath, which was our 9/11 moment, and we want to make sure that that never happens again. So when you talk to Israelis, they don't really want to go beyond the next 24 hours. They are focused right now at the task at hand, which is very different John's point, that's not where the international community is. There's already discussion of what comes next. Israel has said they want to make sure that the Gaza Strip is secure. There'll likely be some sort of buffer zone set up. But the U.S. has already come out and said they do not want to see a reoccupation of Israeli forces in Gaza.
Yeah, it sounds like the Yalta Conference. I can see Roosevelt, Stalin, and Churchill talking about what comes next in the scope of a 6-7 year war. Amory Horton, to that point, the geography speaks. As they move from north to south, in the video we showed earlier, the devastation, 4 or 5 miles from Rafah, in the Egyptian gate, if you will, where do all these people go? Is there a path for these people to take?
Well, Al Jazeera is already reporting that a community near that Rafah gate, already 10 civilians have died and hundreds wounded. This is according to their reporting off of an Israeli airstrike. This is the exact question I asked Admiral Kirby on Friday. Israel had come out and said to all these Palestinian civilians, please flee to the south, because we are going to have airstrikes around Gaza City. Now they're going after, please flee to the south, because they're going to hit the north. Now you have hundreds of thousands, Palestinians move to the south. And I asked Admiral Kirby, where do they go? And his answers were that they told Israel that they do not support southern operations unless they factored in all the civilians. And then his second point is that they urged yet again to think about how to make sure civilians are safe and pursue operations that account for civilians. But that was his answer. Well, there's no direct geographical place that they are telling Palestinians to go. So it does feel like, and where many progressives in the United States are talking about, is that these individuals, these people are trapped.
Well, and this is the reason why I think it's important to put a little more color around Vice President Kamala Harris's view about, being careful and caution. Secretary of Defense Lloyd Austin coming out and saying the lesson is that you cannot win in urban warfare unless you protect civilians. He went on to say, if you drive them into the arms of the enemy, you replace a tactical victory with a strategic defeat. What is the discussion more broadly then about international pressure on Hamas also to release hostages, to potentially get back to the negotiating table with a better offer, given the fact that there has been increasing pressure on Israel? They've hardened their stance. Where is the tit for tat in terms of pressure?
Well, right now, the Qataris are still at the negotiating table trying to get both these sides together. The United States says that truce ended up failing, or it stopped the tactical pauses they had because of Hamas, and it was due to Hamas not releasing the names of the hostages the evening before. There's still a number of hostages, at least about 8 Americans, the U.S. administration believes, is still with Hamas. And I asked Admiral Kirby about this again, and he said he'd be remiss to say that they knew exactly where they were and exactly their condition. So the situation is incredibly complicated, but there's a ton of international pressure on Israel as well to make sure they could try to get more hostages back, not just from the international community, but also Israelis. The majority of those individuals there are Israelis. When it comes to Hamas, there's international pressure all around, but do they really care about international pressure unless potentially maybe it's coming from Tehran or Lebanese Hezbollah?
Anne-Marie, let's finish with things at home. It is normal to have division in any government on massive issues. In fact, some people would say, I would say, it's healthy. How unhealthy is the division emerging within this administration over this war?
This administration and as well as the Democratic Party. We heard from Pramila Jayapal yesterday on CNN's State of the Union talking about we cannot have hierarchies when it comes to crimes, when it comes to warfare. This could be a problem for the president. I think it's why you see a tougher tone. It started with Secretary of State Antony Blinken's 3rd visit to Tel Aviv. We heard from Lloyd Austin over the weekend, the defense secretary, and the vice president, Kamala Harris. Within the Democratic Party in Congress, there's those that now want to put strings attached to Israeli aid. And then within the administration, you're seeing leaked reports and cables out of the State Department that they do not agree with the administration's full throttle support of Israel, as the civilian toll of Palestinians is now north of 15,000.
AMH, thank you. Anne-Marie, down in Washington, appreciate it. TK, the arguments you're going to see over aid on 2 fronts, Israel 1 and Ukraine 2. they are going to be huge in the new year.
And changed over the weekend. One correction, John. Mike out on Twitter nails this. Thank you, Mike, so much. I mentioned Yemeni drones, and he said, let's be careful here. It's not Yemeni drones, it's Houthi drones.
That's a key distinction,
smaller
yeah.
group. Key distinction there, but it does speak to Americans in harm's way here. We are not removed from this conflict because we're floating out in the Mediterranean and the Red Sea.
It's also just become a massive political division that we've seen. The divisiveness within the Democratic Party is something that's going to be transformative in a pretty massive way.
Happy talk in December about everything going on right now. I think the market just kind of ignoring what's happening in Washington, nothing to talk about. Early next year, big reality check, eh?
Very much so. Hitting some deadlines for that budget.
From New York City, this is Bloomberg.
The reception, the acceptance of Puro-Sangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Puro-Sangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Equities on the S&P 500 pulling back by a third of 1%. Just a little softer, lighter negative to kick off this trading week following a decent week of gains. 5 weeks of it. On the S&P, we're down a touch. On the Nasdaq, we're down 0.5%. The Russell, the small caps, up by 0.4. Let's turn to the bond market, offering some support to this equity market run over the last month. Yields are up this morning across the curve, particularly at the front end, up by 6 to 460.21. Last week, down aggressively. Chairman Powell, did he or didn't he tried to push back, Lisa, last week, because if he did, this bond market wasn't listening.
He did without conviction. He tried to basically say a party line that wasn't with any sort of heartfelt meaning that he was going to push back, which the market took as an undying, dovish call for rate cuts starting in March.
So next week, they've got a tool to do something about this, don't they? They've got the summary of economic projections. TK's favourite thing, they have the dot plot. The dot plot for 2024 to signal they're not going to cut anytime soon, except in the dot plot currently, there's rate cuts, isn't there?
There is, but it's later next year, and it's not that many. It's versus the, say, 6 rate cuts that people are talking about now next year, priced in for the Federal Reserve at one point. I mean, it's definitely 100 basis points of rate cuts that we're looking at next year. Do they push back against that? And if they do, does anyone care? I mean, we were saying Powell had a chance to push back. He sort of tried to, and people were like, you just don't buy it.
Not working. FX is harder because you have to make 2 calls. On a 2-year at the front end, you just make 1 policy call on the Federal Reserve. In the FX market, on the euro against the dollar, you've got to make 2 policy calls. And last week, we started to think about the ECB cutting much sooner than the Federal Reserve, Tom. The euro down to 108.68.
George Saravelis at Deutsche Bank was aggressive on that. He said that Lagarde and company will get out front and do what the Bundesbank is worried about, which is say, oops, and cut rates.
He said they should cut next week.
Yeah.
He said they should cut rates next week. He wants to tell us to tell everyone that that doesn't mean he thinks they will cut rates next week. He thinks they should.
I think we're going to go to the jobs report on Friday, and the answer is, okay, you get a shock down. That really changes the debate. But to the Morgan Stanley Goldman Sachs parity, or rather I should say divide, it's all about the labor economy claims on Thursday.
Yeah.
You know, 222,000. That's
still low.
That's a fully employed number.
A payrolls on Friday as well, looking for unemployment still south of 4%. Thinking our survey right now, median estimate is about 180. That can change going into the number. Let's get you up to speed on the top stories. Under surveillance this morning, Israel expanding its campaign across southern Gaza with another ground offensive expected. The military aiming for Hamas leadership as another truce between the two sides appears out of reach. U.S. forces getting involved over the weekend after reports of attacks on 3 commercial ships traveling in the Red Sea. No casualties were reported, but U.S. military officials say Houthi rebels backed by Iran are to blame. Your next story this morning, Occidental Petroleum in talks to buy driller Crown Rock. As consolidation grows in the U.S. oil market, the deal expected to be valued at more than $10 billion, including debt. Crown Rock is one of the largest private oil and gas producers in the Permian Basin. Just last month, of course, Exxon struck a deal, Tom, to buy Pioneer, and Chevron agreed to take over Hess.
Yeah, it's in line. There's no question about that. This is a kid out of Texas Tech, a chemical engineer out of Texas Tech. He worked for Exxon, and then he did just like you see in the movies. He went out on his own and bought up half of West Texas, North Texas. I don't even know where it is on the map. And the answer is it's worth a lot of money.
Apparently.
It's the battle, Bramo, to get scale in the Permian Basin. And the little nugget in our story this morning, and I'm sure some of you have heard this before, but the fact that the Permian yields more oil now annually than Iraq on the OPEC committee cartel is just amazing.
Well, and this actually goes to something that RBC Capital is talking about, and the analysts over there, that we've moved more back into an oil market determined by supply and not demand shocks necessarily. And if it's supply, you take a look at the U.S. and some other non-OPEC members, and they are basically offsetting a lot of the cuts to production that you're seeing from the other OPEC plus members. So when you take a look at that, 2 questions. 1, antitrust is sort of interesting. And 2, how awkward does it make it for U.S. energy officials to go over to COP28 and to talk about reducing fossil fuel emissions and taking the high road on that when the U.S. is accelerating production at a rate that is exactly counter to what we're seeing in the Middle East?
Got the number right in front of me on the Bloomberg. DOET CRUD, remember that one for Bloomberg users. 13.2 million barrels a day. TK, 13.2 million barrels of oil produced in this country every single day.
Do we have a national energy policy?
They don't speak about it.
They don't.
Not that piece of it anyway.
There isn't a national energy policy, and many would say that's why you're quoting those numbers, is because we didn't have it's a really interesting debate. What else do we have?
This last story, Tom. Swiss drug maker Roche looking to join the rush into weight loss drugs. Roche agreeing to pay $3.1 billion for Carmot Therapeutics, which is developing drugs to compete with Ozempic. Roche among the first companies to test a GLP-1 drug, but had to stop more than a decade ago after patients quit due to nausea.
Yeah.
Saw that last week as well, I think, with Pfizer. The weight loss market is expected to reach $100 billion by the end of the decade. And the year-to-date gains in pharma, basically, you've either got it or you haven't. Novo has it, it, Eli Lilly has it, and they're up big time, and everyone else, Tom, struggling to catch up.
And the heart of the matter is who's going to pay for it. I mean, I get the whole efficacy of it in the national. John, you've been very good about this, the diabetes and the heart disease and that. But okay, is this a new government program we're going to have to slosh out $8,000 a year, I'm guessing, for a drug?
We spoke with Sam Fazeli last week, and he was basically saying of Bloomberg Intelligence, who's worked with pharmaceutical research for a long time.
Yeah.
First of all, he said a lot of these drugs have been around for a long time, the technology of them, and that they have not found material side effects over the long term with usage, which raises this question, at what point does it become national policy to reduce healthcare costs? Yes, that will mean insurance will pay for it. It'll also mean that healthcare costs will go down in other ways. It's going to get really interesting, which is the reason why everyone is willing to bid up for this.
Yeah, well, there's the drugs, and John, there's also the Bramble method, which is run 15 miles a day. You know,
that's one method.
That's one method.
But this is also, Tom, about addiction, and I think we're only just sort of scraping the surface around the addiction side of all of this. So this use case can go beyond obesity, Tom, perhaps to alcoholism. Maybe even gambling addiction as well. The use case for these drugs, I think, is only just starting to be explored, Tom. This can make a big change. What strikes me, though, and we've talked about this before, you have to use it indefinitely. Tom.
Yes.
Indefinitely.
Yeah.
So, of course, cost needs to come down drastically to make that work.
We'll have to see. We'll continue to study this, I should say, and we do this with Dr. Fazeli, who's truly world-class. Thrilled to have Sam Fazeli with us at Bloomberg. Right now, and this is a joy, sitting with us here in New York, Winnie Caesar joins us, Global Head of Strategy at Credit Sites as well. In the heart of your note is what I thought about the most this weekend. And I'm going to go to Lawrence McDonald with a great insight this year. The cash on the sidelines. It's jaw-dropping. When yields come down, do they all exit the money market fund to buy Apple?
I don't think that they all exit the money market fund to buy Apple, but there's an awful lot of yield left in the corporate credit markets, in high yield, even in leveraged loans, maybe in equities that is definitely going to be bought. And you don't need to see all of that money come out of money market funds. I mean, we've had $1 trillion go into retail money market funds this year alone. Right. Just a drop in that bucket is absolutely going to drive spreads tighter.
You are pro in the Bramble world. These are questions Lisa should be asking. I'm going to front runner here right now. Where in the spread market is the thing that identifies a tip point when that money moves?
So one thing that I'm looking for is front-end retail flows. They have been absolutely abysmal in corporate credit this year. Historically, there's a very strong bid for that front end because that's where there's actual yield. But right now, cash is where you get the yield, and you have a very flat yield curve. So why would I go into the front end of corporate credit? But once we start to see those flows start to accelerate, then I think that you have a good forward signal that you're going to have a wholesale bid for kind of duration extension and for spread products.
Have the high yield and investment grade bond markets been insulated by the private credit markets in a sense that the high yield and investment grade are both much better quality and more transparent than the massive world of private credit that has grown up and ballooned and doesn't reset in real time?
It's interesting because you historically don't think of the investors in private credit and these kind of smaller mid-market caps as the same as in the investment grade universe. But you see all this institutional cash going into the world of private credit. And I think that it's interesting that you've seen all of that cash being raised while at the same time you've seen very steady institutional demand for U.S. investment grade with very sticky long end spreads. So that indicates to me that you are actually seeing this kind of tandem bid that's almost a barbell strategy in terms of risk, saying, you know, illiquidity in private credit feels okay for right now if I can add some yield to portfolios, but also I do want that core bid in the long end of the investment grade spread curve.
Let's talk about your year-end spread targets for next year. 350. So I'm just looking at the chart. The Fed starts hiking in spring 2022, and you've got credit spreads going back to spring 2022. Next year. What's behind that? Is that with recession, without recession, with rate cuts, without rate cuts?
So we do expect that there will be rate cuts. We think that the first one will be in March. We expect 4 of them. Now, that effectively is market consensus at this point, but when I was telling clients that in October, people were looking at me like I had multiple heads. So we're sticking with that trade. We're not going to add more rate cuts at this point, and we think that still kind of this bumpy landing. It's not going to be all Goldilocks. It's not going to be easy, but we do think that there is a path for inflation to continue to come down, for the consumer to soften up a little bit, for the Fed to actually stay in quite restrictive territory with real yields and real policy rates being quite positive, but with credit markets being able to perform quite well in that environment, with the exception of those really lower rated, highly leveraged, triple Cs, leveraged loans. That's where the real pressure in borrowing costs is going to remain.
How unusual is it to see the unemployment rate climb only a little bit? And when would you know that maybe this is not the right call and to back away from it?
It's very unusual, but also the past 3 years have been highly unusual, right? We still have management teams that are very focused on how can we keep labor forces in good shape to meet whatever demand. And also, we can't always just equate recessions or economic slowdowns to the COVID pandemic or the GFC. You can see this kind of more typical slowdown, more normalization in terms of run rate of demand.
So in other words, do you think that the default cycle is going to be pretty small because rates will come down so much that basically the refinancing risk won't be as significant as it is now?
I do think that it's going to be a very manageable default cycle, and the market has become increasingly good at kind of pricing in forward defaults and knowing where to anticipate those things. Now, the big issue is that we have looser covenant structures. We have this new trend of kind of creditor on creditor violence, and so, big erosion of positions that way. And we do still have a lot of cash on the sidelines in terms of private credit. So, if you have these leveraged loan issuers that are a little bit under pressure, that's more cash that's probably going to get kicked in and extend that default cycle a bit further.
Winnie, thank you. Appreciate the clarity on some big issues. Winnie Caesar there of Credit Sites. Constructive, I would say almost on the edge of bullish there, Lisa, on certain parts of credit. Going into next year, even with this conversation potentially about recession and rate cuts and all of the above.
That's straight up bullish. I think that you can go there. If you're talking about spreads compressing and benchmark rates compressing, that's a pretty significant drop in yields, increase in price at a time when ostensibly we're getting a slowdown in the economy. Again, credit has not sent a different signal than equities. If credit is the leading indicator, it says to equities, let's go.
It's not screaming recession anymore,
No.
is it? No, not at all. If you are just joining us, welcome to the program. The scores look like this Monday morning. Good morning to you. We are lower on the S&P 500, negative by a third of 1%. Yields are a little bit higher by 5 or 6 basis points on a 10-year, 4.2510, and a ton to look forward to this week. In the market, Jobs Friday, Payrolls Friday, just around the corner. The estimate at the moment, 180,000. Tomorrow, stacked lineup, TK, on this program. Taking a visit to Apollo, catching up with our friends Torsten Slok, Jim Zauter, Mark Rowan, and a whole lot more.
This is incredibly well timed, and I give major credit to you, John, for really providing leadership here and putting this together for us. Jim Zelter with us in London a cup of coffee ago. But it's just an incredibly important time to speak to them, not to defend private markets, but to say forward, how does private markets fit into global Wall Street?
Yeah, and how much they're actually taking over a lot of the functioning of a lot of the bigger banks, not necessarily with any disagreement from the big banks. The big banks are saying, we can't afford to be in those businesses anymore from regulatory perspectives, so we're going to work with you. But at the same time,
I agree with that.
That's where lending is really operating in big ways.
And Michael Spence, the lawyer, would say that's what happened. We regulated the big banks out of the risk business because of the screw-ups of 2007, 2008. And with that, somebody else had to pick up the slack, and we call that, it's like KKR last week, that wonderful interview of Shinali's.
The longer-term themes here as well, how retirement investment is going to change in the years to come.
That's where Apollo is, more
fascinating.
conservative, more traditional than the fancy back and forth of private equity.
You can afford to be more traditional if you're getting 5%
Is there breakfast?
on
They're serving
benchmark
caviar?
yields. I'm just saying.
Do we get caviar?
I'm told, I've heard a rumor we get breakfast. I don't know about caviar. Caviar at breakfast.
Has caviar at breakfast?
It's very TK.
There's lox, but not caviar.
The same thing.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID, particularly. So I feel like we just have more to do. My job's far from done.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
A lot of the optimists have been hanging their hat on the strength of the consumer, and the consumer has remained strong. There's obviously appetite to spend. There's appetite to travel. We're seeing the consumer still get out there and spend their money both in stores and online. Right now, I think the market is in this place where we're not sure if we're going to have a cyclical expansion or not. We haven't confirmed in one direction or another, and we're sort of waiting to see.
That was the brilliant Liz Young of SoFi, the head of investment strategy, going into the weekend. And the consumer in America has been spending. We saw record Black Friday shopping online, a record Cyber Monday. And 2 Sundays ago, we had the busiest day in US history in American airports. And we have a deal this morning to talk about for US airlines. Alaska Air agreeing to buy rival Hawaiian Holdings for $1.9 billion in cash and debt. The price action, Tom, stacking up as follows, as you might expect. Hawaiian Holdings absolutely surging, flying even, up by 184%. What was wrong with that?
Well, I mean, the drive of an F1 truck through the gap between GM and Ford's estimates. The shares are flying after the airline merger. This is just fantastic. I love it. It's so good.
Thank you. I'm done. TK, pick up.
On this airline transaction, we will look at it right now, understanding Alaska Air is small and Hawaiian Air is even smaller. Looking at United, Delta, and American Airlines is Helene Becker, Senior Research Analyst, TD Cowen. Why did this happen? Is this two mini dinosaurs mating? What's the why here versus United, Delta, and American?
Hi, Tom. So I think the why is twofold. First of all, this is a continuation of the consolidation we've seen in the past for the industry, but also during the pandemic, we didn't have the consolidation we probably should have had. We had the government stepping in to save the airline industry, and unfortunately, they couldn't save everybody, so now you're getting that washout. And I think for Alaska and Hawaiian specifically, it really will help them cross the bridge to the other side of the river, so to speak, where they'll be able to survive as a consumer brand.
Away from the financial part, Helene Becker, where is the flight that really is going to add value here? Is it LAX to Hawaii, something John's taken 1 million times? What's the flight where you thought, wow, this is where the synergy can happen?
Yeah, I think it's more Hawaii to the mainland. For people who come, first of all, Hawaii, as you know, is very remote. I think it's one of the most remote places on Earth and one of the hardest to get to. And so for people who live in the islands, they do tend to go either inter-island or to the West Coast. They don't really reach too much into the mainland. And if they want to, it's usually more than a one-stop flight. For Alaska, it gives them the opportunity to be bigger. I think the combined airline will have over 300 aircraft. Revenue will be about $13-14 billion. So it's not like they're close, right? Your comment before about American, Delta, United, those are $50 billion revenue companies. These are small. And they serve a purpose. People fly them, right? They fly 80-85% load factors. They both deliver a great product. you're not really changing a whole lot, unlike with JetBlue and Spirit, where you're changing more. Not to say that merger shouldn't occur, but we're looking at airlines, to your point before. Hawaiian's up, 180% pre-market. And that's primarily because under $5, the market's telling you these companies can't survive. And we have a lot of airlines in that under $5 trading range right now. And so we're seeing that consolidation that should have probably already occurred.
TK Direct, Newark, Hawaii, United.
No way. You can fly direct from Newark to Honolulu?
Amazing, isn't it? You can fly direct from Newark on United. There you go.
I did not know that.
Yes, you did.
I did.
Give me a break. Let's get into it, Helene. Not that. The important stuff. JetBlue and Spirit held up. The alliance between JetBlue and American Airlines crushed. What will they allow? What won't they allow? We can see this morning that Alaska are making a very clear statement that they don't think this is anti-competitive. They're complementary businesses. The overlap is only 12 routes, 3% of their total seats. Can you frame for us what is allowed and what isn't?
Yeah, I think this Justice Department doesn't like anything big. And it's not like these guys are going to be big. JetBlue and Spirit isn't big, right? They go to be the 5th largest. JetBlue Spirit goes to be the 5th largest. Alaska Hawaiian is going to be right in there, 5, 6, something like that. It's not like we're going to take over the 4th largest spot. JetBlue and Spirit are 9% on a combined basis. This is even smaller. So I suspect that if they look at this on a I don't know the right word, on a just the way they should, on a not with a jaded eye, where they're just looking at it, does this deal make sense? They should come away with, yes, this transaction does make sense.
Well, Helene, just to put a bow on that, if they approve this transaction, do they have to approve Spirit and JetBlue?
Well, Spirit JetBlue should have, is where it belongs, right? They're in court. Closing arguments start tomorrow. Should take to the end of the week, I would think, if even that long, and then the judge renders his decision. So, the one-word answer, Lisa, is yes, they should just move on and go fight other battles.
How much is this going to be some sort of consolidation of aircraft, consolidation of workers, consolidation of operations, and how much is it going to be just the actual geography of these places? People go to Hawaii in the wintertime and people go to Alaska in the summertime, and they can offset each other.
Right, exactly. So two things there to think about. They're both kind of bucket list trips, right? From the mainland, especially the East Coast, it's 15 hours nonstop on the United flight out of Newark. Hawaiian flies out of JFK. They used to fly out of Boston. That flight, I think, came back post-pandemic. So they do fly here on a nonstop basis, but those are 15-hour flights. So those are bucket list trips if you're coming from the East Coast. In terms of operations, they said last night that they're going to operate the two separately, one operating certificate, but two separate brands, sort of the way hotel chains do it, right? You have 14 or 15 brands under one major holding company. Same thing here. They're going to just operate Hawaiian separately and Alaska separately because both companies really do have great brands and they're well loved by the people who fly them a lot.
Elaine, just to wrap things up, to get your top pick, the airlines have bounced recently, but are still some 27% from the altitude we hit back in the summer. Do you like that, Bram?
That was good.
For you.
That was
Thanks.
really good. I liked
was proud
it.
of that.
That was good.
Elaine, what is your top pick at the moment? We had the busiest day on record for US airports only a couple of Sundays ago, and these stocks over the last few months, yes, more recently have rallied, but it's been difficult since the July peak.
Yeah, people have been worried about the consumer recession, et cetera. So our best idea for 2023 was United, and our best idea for 2024 is Delta.
Why the change, Elaine?
So the change primarily came for two reasons. One, United's been our best idea for the past 2 years, and it's mostly worked. But they're embarking on a $60 billion 10-year CapEx program, and we don't think Delta's is going to be quite as aggressive. We think Delta's will be smaller than that. At some point, they'll have to replace the 717s. They'll probably do that with A220s, but it's a much smaller CapEx program. Delta has a similar footprint to United. They're just a little bit bigger domestically than United. United's 50-50 domestic international, while Delta's more like 60-40. So we just pivoted a little bit to Delta, the balance sheet, the order book. Those are a couple of the reasons why.
Appreciate the update, Helene. Helene Becker of TD Cowen. Best idea for next year, Delta Airlines. We've got a pretty even split around the table. No bias here on Bloomberg Surveillance. TK United, Bramo Delta. I'm sitting here for American. Bramo,
Pretty good, yeah.
Delta analyst.
Yeah.
Top pick for next year.
Well, I think there are a couple things. First, they did back off on some of the point changes to get into the lounge.
They're listening.
Delta One is, nice, but I also think they're American Express. Combination. And they're basically, how much are they becoming a financial company versus actually?
I mean, Lisa, when John goes to Hawaii, I mean, he's staying at the Moana. I mean, it's where President Obama
Is he gonna
stayed as well. But John's large.
It's a lofty place.
He's at the Moana, and he's right by the beach there.
Actually, I was in Lanai and saw Netanyahu.
Yeah, how about that landing into Lanai?
Yeah,
I don't think so, no.
How about that?
That's rough. That's rough. Let me tell you.
Rough. I mean, you're looking at when folks on a cliff here.
When it starts doing that as it's coming in, and all you see is this red cliff.
Welcome to Hawaii.
It was romantic and beautiful.
Until it wasn't.
Scenic until it really wasn't.
It really wasn't.
And haven't been back. Don't think I'm going back.
Oh, there's an endorsement.
Yeah.
It'll be
it's a beautiful island.
You and me at the
beautiful
Moana.
Island. Let me be very clear. Beautiful island. Let's just say,
Not so much.
No. Small planes, me, no.
Brutal. Worst ever.
Just
Worst
no, thank
ever.
you. Not for me. From New York City this morning, good morning. Stocks are lower by a third of 1%.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think certainly we're at the end of the tightening cycle.
The economy is going to stall later next year. The impact of policy tightening is clearly coming through.
The market's gotten into its head that no hikes equals cuts. And I don't think that's quite right.
2024 is really a recalibration of monetary policy.
The only thing we're really certain about is that the market is facing uncertainty.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. A Monday to carry on from last week. Market's a little shakier, but John, wow. After a Friday that just shocked into the end, the 10-year real yield under 2%, we have to recalibrate into the jobs report.
41 basis point move at the front end of the curve, 2-year yield lower, and we've said it repeatedly through this morning. If you think Chairman Powell was pushing back, he got steamrolled by this bond market on Friday. TK, this market believes this Fed can cut for all the right reasons. Disinflation without a recession. That's the good stuff. Will the labor market hold up? Look to Friday. Based on these estimates, it will. 3.9% unemployment, 180,000 on payrolls growth. And Tom, that looks pretty good, doesn't it?
And pushing against this is GDP. I mean, there's a lot of fancy work, OECD, IMF, global slowdown, and all that. And to me, the zeitgeist this weekend was, well, maybe with the consumer the way they are, we're not going to see, recession, maybe Tony Dwyer looking for that, but just maybe not the gloom slowdown that gets you to the bear market call.
Alarian warned about this going into the weekend. He said, extrapolating out the euphoria, the understandable euphoria of the last month or so, Tom,
I think you meant the tots.
Maybe that's a mistake.
Yeah.
You did something over the weekend that I quite liked. I think we should do this. The Economist of the Year. We should have the equity strategist of the year.
I do that. I think people care.
Let's do the Economist of the Year right now.
Because there's a lot, but the Economist of the Year is the guy that delivered optimism and a belief in the American experiment out of this terrible pandemic. A guy named Neil Dutta at Renaissance Macro wrote a brilliant essay for Business Insider with nuances carrying forward his optimism.
I pulled out a quote from that, TK. Lisa, what do you make of this? If 2023 was about the hard work of stabilizing the economy, Neil Dutta of Renaissance Macro says, then 2024 is about enjoying the fruits of that labor.
This is something that is a tension point for me, because if you enjoy the fruits of that, that means disinflation, a return to maybe 2%. How? And this, to me, I think is the biggest question. How is that, given some of the increasing optimism around the numbers that we've gotten and the fact that people are still spending money? Is that disinflation? Does it really warrant 5 rate cuts that are currently priced into the U.S. market next year?
I read Mike Wilson's note carefully, as a leader of the bear market, cautious, one of the guys out there saying, forget about the bull market. But the answer is there a bear market call right now? I really couldn't find it, except for one guy over at J.P. Morgan I don't think he's in the new building they're building.
4,200 with a downside bias over at J.P. Morgan, the investment bank. That's the call.
There's different parts of J.P. Morgan we should
This is the investment bank. This is the research team led by Marko Klanovic and Dubravko as well. Look, the call stacks up. Whether you disagree with the number, the logic kind of makes sense. And Lisa and I were talking about this on Friday.
Sure.
What is the bet in the market right now?
Sabbatical.
J.P. Morgan is essentially saying the bet in the market right now is a near perfect soft landing.
Right.
And ultimately, Lisa, they're pushing back against what's priced because they don't think it's going to be that great.
Well, and Dan Morris kind of alluded to this, that it was sort of heads you in, tails you, I lose, or something like that for equities when it comes to, I totally messed that up, but this idea that, when it comes to the payrolls report, if you get an upside surprise, it's going to be bad for equities. And if you get a downside surprise, that's going to be bad for equities, because essentially they're pricing in a Goldilocks that only a number that comes exactly in line with expectations can confirm.
We've backed up on the 10-year inflation-adjusted yield. Never did I think, John, we get so abruptly under 2%, 1.9x%. We backed up to 2.04%. I guess waiting to see if we get more dovishness out there.
Huge turnaround for bonds. So let's go through it together. The 2-year at the moment, 461. It's up 7 basis points today. But think about how much lower it is compared to October, mid-October. 5.26 on a 2-year, pushing those levels. On a 10-year, back in October, through 5%, back down to 4.26, even with a 6 basis point move this morning. So that's a turnaround for fixed income. Elsewhere in equities, we're negative 1/3 on the S&P 500. And what do you do with the euro, TK? The euro 108.67, slightly negative. Forget the Fed call. You've got to pair it with an ECB call. Call of the morning. George Saravelos,
no question
Deutsche
about
Bank.
it. Yep.
He said, based on the data right now, they should be cutting next week at the ECB. Doesn't think they will, thinks they should. Call of last week, Jeff Yu, BNY Mellon, he thinks, Tom, we go back to parity on the euro next year.
I just think these are some of the dynamics, and I do agree with you. You've got to parse together the major banks, even Bank of Japan and that soap opera.
Bank of Canada.
As well. Right now, on the what do you doing is Dana Dioria, co-CIO group president of InvestNet. It's one thing to talk economics, finance, investment. It's another to say, okay, this is what you should do. Dana, I've got to go to your wonderful paragraph on the Magnificent Seven. You've got some enthusiasm, but you brilliantly show that they're 28% of market cap, and yet they only deliver 17% of earnings. Why do we own them up to our eyeballs?
Well, you know, that is the nature of growth, right? The multiples are certainly higher, and let's face it, in the last several years, they have proven to be truly defensive as a play, as well as, you know, the bull run coming from them. So it's really hard to argue yourself out of the Magnificent Seven at this point, and all sorts of problems in terms of active managers. We have, you know, hundreds of active managers on our platform, and, you know, even to the extent that now when trying to diverge from the index, you have problems because Magnificent Seven is so big in there. So certainly my remarks are not to say that you're going to divest the Magnificent Seven. That has not gotten anyone anywhere. But I would say focusing even more on them is not the place to be.
Okay, Dan, I'm going to rip up the script here. This is too important. Are you tilting then in helping people with a balanced portfolio, active or passive investment?
Well, you know, we are very much believers, and we actually have a lot of research on active and passive investing that, you know, that both need to be in the portfolio. I know that's not as fun of an answer, but the bottom line is that passive investing has gotten to be so low cost that the average investor is very hard for an active manager to outperform passive on a regular basis and beat their fees as well. That being said, we know that there are certain style factors that work. There are certain strategies that work. And, you know, if you're sticking only with passive and you're in an advisory relationship, you want to outperform the fees that are attached. You want to outperform tax. So we think both need to be in the portfolio. Certain asset classes might be better for active, particularly quant active, than others.
Right now, I'm looking at a bond market that really has a mystery baked into it, which is, can the Fed really cut rates by more than 4 times next year, which is basically what the market is baking in? Do you lean against some of what some people are calling the euphoria of a soft landing, the Goldilocks forever that we heard from Max Kettner?
I do, but it's getting so hard to be there, right? Because you've been sitting there all year. The market just keeps telling you you're wrong. I genuinely believe that it happens with a lag. And, you know, you talk about that on, a broadcast like this, and the expectation is that you're talking about something that's happening any moment, right? But the fact of the matter is we had massive increase in interest rates that just haven't totally hit the economy yet. We have indications from, you know, proxies for short rates that it's actually tighter than the Fed funds rate would suggest. So I do think that, you know, the market has a decent chance of slowing down next year. Does it mean it's a massive crash? No, not necessarily. But I don't, advocate kind of chasing after stocks and not being balanced in the way that you go to the market, which is what we kind of see, right, on our platform. Again, when you look at what are the big winners of the year, it's S&P 500 ETFs, it's QQQ, you know, it's where folks are just trying to make sure that they don't lose out. But, you know, balance in that way that you're engaging with the market, I think is appropriate. And I do think that we're going to see some impact. I also think inflation may not be defeated, right? Inflation tends to come in waves. So everyone's talking about disinflation. Hey, that'd be great, but I don't think we're able to make that call yet.
Danny, do you think we might be confusing a conversation on the economic cycle with one on the profit cycle? I think RB Advisors have been great on this. We're having a discussion about an economic recession that might be in our future, when arguably we've had the profits recession already. Danny, do you think we have?
That's a very good point. I mean, look, most of this year that has been the case, right? And then, you know, there's questions around productivity and does AI step in and make it possible for companies to keep doing very well next year, right? We seem to have in this last earnings season turned the curve on that. And so, you know, next year, presumably we're out of it and we do well. But of course, again, when you think about credit tightening the way it is and continuing to tighten, and the bifurcation now you're seeing, which is interesting too, with, for example, large cap and small cap growth, right? It's not just about where interest rates are, it's about what firms can self-fund, have enough cash to handle their operations and don't need to go out to credit markets, don't need to be turning over debt in a situation where debt is going to be much more expensive. So I think all those things come to bear. I think there's an argument to be made that we have had the earnings recession, but that doesn't mean that there's not more for corporate teams to contend with next year. Again, for example, if you need to go to credit markets to fund your operations.
True. Dana, thank you. Dana Dioria there of Investnet on this market, Tom. The difference between a conversation about an economic recession that might be in our future and perhaps a profits recession that may well be in our past.
You know, what's great about that is it's about what do you do? And she alluded to the fact so many people have missed this market. We're all talking about the great November and things are great into December and it's double digit, and even SPX up double digit. And yet when I talk to people, they're not feeling the good feeling.
Well, it's where are they, right? I mean, the profit recession where? The profit recession in tech, yeah, that's over. The profits recession in other sectors that have been beaten up, like, for example, banks, maybe to some degree, although I don't know that we ever had a profit recession there. But in small caps, you continue to see a lot of pain there, right? So there's sort of this question of where does the recession hit? If it hits small caps, you can still see pain, but the headline figure on the S&P and the NASDAQ can still go up quite significantly.
The massive extremes. I believe I did this. NASDAQ 100. The top 7 stocks are like 38 or 41% of the index. I mean, it's absurd.
This market's upside down sometimes. You see the banks last week. Banks on the S&P, Bramo, up 4% last week off the back of a 40 basis point plus move at the front end of the yield curve. We came into this year and our understanding of the bond market and relationship between bonds and bank stocks.
Yields up good.
Yields up good, yields down bad.
That worked out.
This year, yields up bad, yields down good.
You know, I can't really explain it right now. People point to the yield curve that maybe it was less inverted. People point to the fact that higher yields are good, but at what pace? Higher yields at too quick rates are difficult for banks that are holding on to pretty big portfolios of treasuries.
We'll have this discussion a little bit later. If you're just joining us, here are the scores on the S&P 500, negative 0.3%. Yields higher, Tom, by 6 basis points, 425.68.
On Friday, 4-something p.m., the Wall Street Journal featured the Bloomberg Total Return Index is a good measurement of bonds price up, yield down. I went to the Bloomberg Total Return Index, John, this morning, and I looked at how far do we need to go up to get back to the good times. And the drawdown in price, we need to go up 14%, which I'm going to put at, say, almost 3 years of coupon to get back. There's a lot of total return we need to do to get back to the good feeling we had in bonds after those losses.
We had a lot last month, let's put it that way, but yeah.
Nice jump, but there's a long way to go.
We'll have that conversation in the next hour on Bloomberg TV, on The Open, Sonal Desai of Franklin Templeton, Greg Peters of PGIM, and on the equity market, the year ahead in 2024, Barry Bannister of Stifel. I imagine Sonal might have some pushback for the move we saw in the bond market, Elisa, last week.
I suspect so. I think a lot of people are starting to think about it. I mean, you can hear that from Max Kettner. He kind of doesn't believe it. Nobody really believes it, but when do you actually push back against it? Do you kind of ride it for a bit longer? I mean, that's sort of the discussion people are having.
The title of Max's note is still Goldilocks forever. Question mark. I mean, I get there's a question mark in it, but he's still pushing Goldilocks.
That's my point. It's sort of what's going to make it stop.
Yeah, I'm with you.
I mean, do you feel Goldilocks?
Do I feel it?
Yeah.
Do we ever feel it?
Expectations with the mergers of some airlines.
Oh, right. That was good.
That was terrible.
Nice pun, Bramo.
Oh, thanks.
From New York, this is Bloomberg.
names in global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. Tuesday, a special episode of Bloomberg Surveillance live from Apollo's headquarters. Join Tom, John, and Lisa for exclusive interviews with top leaders in finance, including Apollo's Mark Rowan and Jim Zelter, about the state of private markets, recession risk in the new year, and deal-making amid high interest rates. It's all happening December 5th, starting at 6 a.m. Eastern on Bloomberg. Context changes everything.
Very important because the reality is that we've had the hottest year on record. We're aiming for another hot year. Clearly this has to change, and you can't make climate and fight the climate issue without money coming to work on it. So it's one of the most important things. When I traveled around the world, I picked up the impression that dealing with poverty cannot be by itself. You have to deal with climate, pandemics, fragility. These are all intertwined crises. That's why we changed our mission to include livable planet in addition to eradicating poverty.
Ajay Banga, the newly minted president of the World Bank, in good conversation with Bloomberg in Dubai. It is a gathering of the elite as they discuss climate change, which is, of course, front and center. Tom Keene and Lisa Bramowitz with you. John Farrow in preparation for a magnificent 9 o'clock hour. Lisa, your thoughts on COP, whatever it is, as we go to COP 28, 29, 30, and on an annual basis?
Well, there is both a bit of fatalism, right? We heard about people basically saying it seems almost inevitable that we're going to breach that 2 degrees increase that people said was the point of no return. But there was a greater commitment from the OPEC plus nations to possibly cut some of their emissions. And then there was also this question around new energies like carbon capture. I'm actually very curious in what can really get involved there, but clearly that can't offset just reducing emissions.
Some of the nuances that are out there, some of the sub-themes, but the overwhelming theme is the United States, China, and use of coal. David Turk joins us now with Secretary Granholm. He is U.S. Deputy Energy Secretary. David, thank you so much for joining us, and you do so with your service to the nation of 6, 7, and 8 jobs in climate. The immovable fact is we're trying to do something about coal. My latest reading is China's really not doing something about coal. What is the department's timeline in America to diminish coal usage?
Well, first of all, Tom and Lisa, thanks for the time, and really appreciate you being with you today. So we've got to look across the board. It's not just coal, it's natural gas, it's oil. We've got to look at all the sources of emissions, and we've got to have a plan to build all the new clean energy. And this is what we've got in the U.S. We've got historic levels of funding through the pieces of legislation, the bipartisan infrastructure legislation, the Inflation Reduction Act. We're building out our clean energy future like never before in our country. It's quite staggering what we're doing.
I go with that, and of course in the FT this morning, a huge difference between a complete climate commitment in Europe to the fractured battle you fight every day in the United States. But to look at coal is one example, particularly with the Chinese just ignoring the debate on coal from everything I read. What is the administration's path to shut down or diminish coal usage across America?
So we've seen dramatic declines in coal in our country, and that's projected to continue going forward. It's because we have cheaper, better alternatives, solar and wind. The solar penetration we've got in our country, the wind, other clean energy technologies, they're just simply cheaper and better, and so the market is reacting to those incentives.
David, I'm looking right now at WTI crude traded on the NYMEX at $73.46. Is this a good time to start refilling the Strategic Petroleum Reserve?
So we have been, and we're going to be opportunistic, and we're going to take every advantage when the price is at the right level to make a good deal for taxpayers. We're going to refill. So we are refilling as much as we can. We've been doing that for the last several months, and at this price level, we'll keep doing it.
And it's been about a 3 million barrel a month purchase that the Energy Department has been making. Do you plan to accelerate that, though, as prices do continue to fall?
So that is the physical limit of how much we can buy back. We've got some lifetime extensions in some of our caverns. We actually have 4 separate facilities, 4 separate sites for our Strategic Petroleum Reserve. So we will be doing at least 3 million barrels. And we hope we can bring more capacity online at these price levels to buy as much as we can to refill, to make sure we've got that available when we need it in the future. So we'll buy as much back as we possibly can, but there are some physical constraints given the way the caverns are set up.
We've been talking a lot about some of the consolidation in the shale patch with a number of companies coming to the fore, the latest coming this morning. Is this a good thing from the Energy Department standpoint or a bad thing?
So as you know, a lot of decisions that are made in the energy sector, certainly in our country, are private sector decisions along those lines, and we're certainly seeing that happen as well. I think one good thing we've certainly seen is a focus from a lot of companies, including here at the climate conference, on reducing methane emissions. This is something we've been after for quite some time. Our EPA colleagues recently announced some big news here in terms of the new regulatory structure to really do what's the biggest no-brainer, I think, in the history of no-brainers on climate, is reduce methane emissions in the oil and gas sectors. So we're really stepping up on that, and we're seeing some companies step up on that beyond what they're required to do in the U.S.
I'll take your point on it. There's some real traction on that. You know, I want to go back here. You were an advisor fresh out of Virginia to Senators Biden, Senator Conrad. You've had 18 jobs in energy. You've arguably, David Turka, Republicans and Democrats have more experience than anybody breathing today. How did we get to being an OPEC-sized oil nation? All of a sudden, we're like as big as a rock, or, you know, I'll let you decide what it is. How did we get to this hydrocarbon success that America is today?
Well, first of all, Tom, thanks for the compliment. I'll make sure my mom sees this and hears such a nice compliment. I think the short answer is we are a private sector market, and unless you have federal laws, federal restrictions, the private sector will do what the private sector will do, and they found a lot of profit and a lot of opportunity, including and especially in shale in our country.
What do you say to the critics of the Biden administration that it is not private sector centric?
So look at the numbers, look at where the production levels are at. We also need to, of course, focus on the emissions coming from all of that oil and gas, not only that produced in the U.S., but around the world. And one disappointment I have to say here at the climate conference is, while we've made some progress on methane emissions, that's a big deal, I don't think there's as much focus as there needs to be on oil and gas Scope 3 emissions. That is, those emissions produced when that oil, that gasoline, goes into the atmosphere. Scope 3 emissions are actually 10 times the amount of Scope 1 and Scope 2 for many oil and gas companies. So we need a lot more focus on Scope 3 emissions. We need a real credible plan for dealing with those emissions.
David, does it make it kind of awkward for the U.S. to have a leadership position in reducing emissions at COP28, given the fact that U.S. production has increased to a record pace, even as it's cut in places like Saudi Arabia and Qatar?
So I feel incredibly proud to be part of this historic Biden administration when it comes to climate change. In fact, we are actually seeing our emissions decrease in the U.S. 3% in 2023, despite GDP growth healthier than just about every other country in the world. And what you've seen is, with the historic pieces of legislation, all we're doing in this administration, we're expected already, just in these few short years of policy, to actually double our emission reductions by 2030, 40% plus reductions just from the actions from this administration. That's an impressive record, and we need to do more. All countries around the world need to do more, given the the climate challenges that we face and we're already seeing in our world today.
David Turk, thank you so much. He's a Deputy U.S. Energy Secretary, of course, from Dubai this morning. I can't say enough, Lisa, Democrats and Republicans, how these are the people that drive the conversation. They may disagree collegially around the table, but you have guys coming out of these academic schools, they've got 6, 7, 8, 9, 10 jobs along, the theme.
And the concept of reducing emissions and the complications along the way really underscores
the political debate,
some of the conversations had over in Dubai.
There's a conversation about a jobs report. We're going to dive into that here. First, real look at it. I think that's cool. Who would that be with? It has to be with Michael McKee. Futures negative 16, the VIX 13.27. Stay with us. Bloomberg surveillance.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg surveillance, good morning. John Farrow on assignment, waiting for the 9 o'clock hour. Lisa Bramwitz and Tom Keene. We need to do a market check real quick here, and I got one oddity I really want to emphasize here. The VIX 13.28, SPX negative 16, down negative 89, NASDAQ in 0.5%, down 0.5%. I should say yields are higher off of the Friday festivities. Maybe that's a reversal, some trend there into the opening, to say the least. Lisa, Euro Swissy, and this is again like the 10-year real yield in the United States, showing strong Swiss franc off of what we saw Friday. And, you know, I just get back to the idea of some real movements Friday that changed the landscape.
Well, and George Saravellos and Jeff Yu over at BNY Mellon both think that the ECB is going to cut rates before the Federal Reserve. You have to wonder if the Swiss National Bank is looking at this and saying, come on, really? Because the strong currency has been a problem for a bit. So this has been sort of a tension point, and keep watching this space.
These are the little global tension points that are out there, including Saravellos talking about the ECB. They should act sooner rather than later. Again, futures negative 17. What do you have?
Well, it's an incredible week, and I think about the drumbeat to Friday, kicking off with factory orders and durable goods today at 10 a.m. Tomorrow, JOLTS data, followed by ADP, which no one cares about until they do. Bank CEOs are going to testify before Senate on Wednesday. I hope they ask them about what they're seeing going forward in terms of consumer spending. Thursday, weekly jobless claims, and all of that is kind of the drumbeat. The U.S. jobs report on Friday, which a lot of people say could really make it or break it depending on the number, and then it'll come out bang on exactly the target, and people will move on to saying it's just all about the Fed meeting and how Jay Powell is going to message that.
We're going to get to Constance Hunter here, but first, Michael McKee joins us to get us started on a clearly eventful week. Is a JOLTS survey going to jolt us tomorrow? You once lectured me, tore me to shreds, Lisa McKee. Oh, yeah. I was in the McKee timeout chair. Tom, JOLTS matters. Why does JOLTS matter?
Well,
tomorrow?
It's starting to matter a little bit less, unless it goes up significantly for some reason. But right now, we're expecting the number of job openings to have fallen a little bit, according to the consensus, by about 253,000, which would be, reasonably good news for the Fed. But as Lisa said, it's a week of a lot of numbers that will lead Wall Street to sort of give us the statistical version of angels dancing on the head of a pin. Because every little number is going to give somebody some reason to think that things are going one way or another. The interesting thing is it's been a week now since Chris Waller came out and said that the U.S. economy is starting to give, and that sort of let the floodgates open in the bond market. Yeah. But when you look at the numbers that we're going to get this week, we're expecting a better ISM services number, higher ADP numbers, higher jobs numbers. Now, there are caveats to all of those, but it's not like the economy is falling off a cliff.
So let's look at Governor Waller, whose acclaim is research head at the research institution, the Federal Reserve Bank of St. Louis. There's a multi-decade heritage there. And then let's look at Claudia Samm's essay this week and on the veracity of the data that you live and breathe. Is Professor Samm, is Dr. Samm recession queen? Is she onto something here that we can't trust the data this week because it's not countable?
I don't think we can't trust the data. There are a lot of reasons that the data may not be quite as reliable as they were, basically having to do with response rates and the way the economy has changed in terms of technology. But the data are going to be what the Fed uses. So you can use the data. You could say the data may be wrong, but then they're wrong for the Fed decision making too. And unless you have the right answer, this kind of goes back to the old Jack Welch thing of we've seen the BLS manipulate the numbers and didn't make any difference, and he didn't turn out to be right.
I want to go back to where we started, which is that Jay Powell tried to send one message and the market heard something else. I do think that there has been a notable shift in terms of Fed officials not pushing back against the market sentiment, and that's what Ian Lingen and Benjamin Jeffrey from BMO Capital Markets said when they wrote Powell was more balanced than hawkish, which, given the current backdrop, might as well have been dovish. I mean, is that essentially where we are with the Federal Reserve that doesn't care if the market rallies because they do see so much weakness in the pipeline?
I don't know if it's because they see so much weakness. They do see the economy slowing down, and they do know that we have an issue coming up with real rates. We'll see what happens. I mean, you look this morning, and you can see that financial conditions have tightened a little bit after last week. So we'll see that go up and down. But the biggest thing going forward is going to be, I think, the Fed meeting. Jay Powell's always important, but we're going to get the new projections. And remember, in September, they said they were going to cut rates in 2024. So the idea that the market is pricing in rate cuts is not wrong. It's just a question of timing and, of course, magnitude. That'll depend on the data.
Michael McKee, thank you so much. Greatly appreciated. A busy, busy week for Mr. McKee. Joining us now with macro policy perspectives is Constance Hunter. She's senior advisor with terrific decades perspective here on your central bank Constance, to the question I was alluding to with McKee, the basic idea is, do we trust the data? We're out of a pandemic. Maybe we're beyond a pandemic. Is the data, does all this data have an asterisk next to it, or do you actually believe it's countable and legitimate?
So, I mean, Claudia Sam brings up a good point, and it's something that is talked about a great deal at the statistical agencies. In fact, I'm on the Federal Statistics Economic Advisory Committee. That's a mouthful, FESAC. And we have a meeting this Friday, and one of the agenda items is this exact subject of how is the response rate compared to pre-pandemic, and what needs to be done to A, get it up, and B, use other data sources, triangulate data, have the statistical agencies evolve, but still have the robustness in the data of the random sampling. And that's where the rubber meets the road, is making sure that you're getting an appropriate sample.
And Constance, to your work at NYU and Columbia years ago, the world's changed. We have cell phones. Many people don't have home phones. When we do these statistics, are we counting America, or are we missing parts of America that make us look at the statistics and say they're suspect?
Well, the question really is, are we counting enough that we can then use statistical methods to make assumptions about the economy and the population overall with the proper distributions? And some of what we're talking about here is the response rates of companies sending in survey data to the Fed or to the statistical agencies rather, some of which is the Fed. And of course, we had a great deal of labor market churn during the pandemic. We had a lot of people moving jobs. So the stability of the actual individuals at companies turning in these surveys has seen a lot of tumult. And that has caused some of this reduction in response rate. So addressing it from all angles is really important. And I would say at MPP, what we do is we have an exercise where we scrub the earnings data. And we look at various things like hiring intentions, firing intentions. We're triangulating all the time to see if we can corroborate the official data. And in a sense, that is what the Fed is doing as well.
How much do you see a real dissonance between big companies that are winner takes all and smaller companies that are really struggling much more directly in line with some of the anecdotes that we keep hearing about?
Yeah, I mean, that's where you see the liquidity conditions really take a bite, of course, is smaller companies with different access to credit. And perhaps that weren't able to go to the capital markets when rates were very low and see a bigger maturity wall coming, or just need access to credit for operations. And this is where the financial conditions really take a bite, is these smaller companies. And so when thinking about the economy overall and thinking about hiring plans, right, it is the smaller companies that are feeling a greater pinch and looking more to either slow hiring plans or consider layoffs.
Spotify isn't a tremendously small company. It's a mid-size or larger company. It is a tech company as well. They said that they're cutting 17% of its staff earlier this morning, and said economic growth has slowed dramatically and capital has become more expensive. Spotify is not an exception to these realities. You can make an argument that they're also making excuses for other issues that are much more specific to the business, but do you expect this to be the beginning of a whole host of comments like this based on the commentary that you're hearing as you scrub those earnings?
So we aren't seeing a big jump in firms saying that they're planning to lay off workers. We're at about 5.4% on that, and that's relatively low. But when you look at a company like Spotify, you have to think about how these companies reacted during the pandemic. A lot of them overhired and really staffed up during the pandemic, and now they're sort of right-sizing their businesses for a more trend-level growth as opposed to the blockbuster growth we saw during the aftermath of the pandemic.
So do you buy into this idea that we could see a job-full recession or a job-full landing that leaves us with basically an unemployment rate that doesn't rise that much more, but ongoing disinflation that brings us back down to the Fed's target?
That is, Lisa, precisely our base case, right? We're looking at 4.1% unemployment by the end of next year, but inflation very much in line with the 2% target across all of the measures, both CPI, PCE, and core PCE.
Constance, how ex post is the Fed right now? I'm big on data dependency and all the other fancy languages, but post-pandemic, in their mere mortals, to me, they're as ex post, after the fact, wait, than they've ever been.
So, look, they're fighting a really important perception battle, right? And it's kind of fallen out of the conversation last week, but coming into Thanksgiving, there was a strong conversation about, oh my gosh, look at these prices, look at where they are relative to the beginning of the pandemic, look at the annualized rate relative to the beginning of the pandemic versus, yes, the month over month is coming down. So Wall Street economists, we're looking at the month over month rate and we're easily translating in our head, oh, that equates to a 2.2% annualized rate. We're on a good path. If you're a person living out, not only are you subject to money illusion, where you have a somewhat irrational response to price changes relative to your income, you also anchor to certain things that have gone up in price, and you don't anchor in a smooth way. And so they have a perception issue with Main Street versus Wall Street, and making sure that inflation expectations are anchored. That's an important part of their calculus right now.
Constance, thank you so much. Constance Hunter, a macro policy perspectives there on the Fed Chat Forward. And what I learned there from McKee and Hunter, at least it's just simple as this. Boy, we can have a different view Friday in the vicinity of 8:32 a.m. There's a lot of data coming out.
And it's going to be interesting to see how much we can extrapolate out. This idea of a job-full recession, right? This idea of a job-full downturn, this idea that you're not going to get layoffs because people are still hoarding labor, is a real question mark at a time where you also have a lot of industries in flux. It's a big question to me. That's what I'm most curious about. Do you see maybe a decline in hiring, but not an increase in unemployment filings? Could that be kind of what people are looking toward?
There's a lot of dynamics there. And what's interesting to me is the regional dynamics, and you see it in rent and housing and the rest, where the West is really pretty soft as well. Futures deteriorate. It wasn't Constant Hunter's fault. We went from -15 down to -22. That's half of 1% down.
Yeah, and coming up, we're going to be just parsing out how much we can carry over from November into December. It feels to me like people want to push back against some of the move that we saw last week, particularly in the longer-term yield space, given the fact that they don't really buy that the Fed's going to cut so aggressively next year and that inflation may remain somewhat elevated, but they don't really have the conviction to do so. It's kind of my feeling right now in the market.
Well, it's going to be interesting to see. And, you know, I think there's a lot of Fed gazing and all that, but to me, it's about the data dependency that we've talked about. And I look at the data dependency as when does the job market crack? And to Neil Dutta's wonderful essay in Business Insider, clearly the optimist of the year, the one who nailed this more than anybody in the trenches. How lonely was he? Is the labor market just flat out hasn't cracked. There's no other way to describe it.
And we're talking about that even though Spotify said that it was cutting 17% of its staff, right? In another time and place, people would have said, you know,
well, sum it up. They've cut 25% with the three. They're on their third tranche of rationalizing.
I mean, honestly, some people would say this is the beginning of something broader, especially because they cast it as a larger economic story in their release explaining this. Is it that? Is it just simply they overhired? Is it the whole tech overstaffed story? Or saw back in the day?
Just possibly, maybe I was wrong that the great zombie roll-up wasn't last year as I thought it would be, but maybe it's this year.
Are you saying someone's going to take out Spotify?
No, look at Alaska and Hawaii and Hawaiian Airlines. I mean, there are two airlines that basically can't survive unless they mate. I thought Helene Becker was very good.
What did you say? Mini dinosaurs?
Mini dinosaurs. You know, is that what they are? I don't know. We'll listen to the pros on this. Stay with us. Bloomberg Surveillance.
The reception, the acceptance of Purosangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Purosangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
For the next year, yes, we expect rate cuts. Yes, we expect the data to slow. We expect a recession by the second quarter of next year. Not yet, right? This market's getting really ahead of itself. What you're seeing is a massive compression in term premium, which is very interesting to me because that's not something you typically see at this point in the cycle.
That was Gennady Goldberg, TD Securities head of U.S. rate strategy, pointing out what Tom's been mentioning throughout the morning, which is the real yields, that sort of spread compression, and that idea that we're really seeing that move in yield space having to do with that, which has been underpinning a lot of the risk-on feel that we feel throughout the market.
And the risk-on feel, and Mohammed El-Arian featured that early this morning, London time. You see, he thinks he's up early, but he's really only getting out of bed at like 10 a.m. It's like a, professorial thing.
It's like people in D.C. get up too late. People in London are just faking it because they're actually getting,
Try to get breakfast before lunch. But the answer is Dr. El-Arian said, look, it's a risk-on feel. And even with a pullback this morning, Lisa, it's negative 23 on futures, down 0.5%. The risk-on feel endures.
Chillax. That's sort of what we heard this morning from Jim Dwyer. I did want to take a look at a couple stocks that we've been talking about throughout the morning. The tie-up potentially between Hawaiian and Alaskan Airlines, sending Hawaiian Holdings up 181%. I love quoting this in percent, considering that it's up $8.79. So we're talking about $13.65 for the share price. We heard from Helene Becker earlier is that when the share price falls that low, it basically is a signal that it is not a viable airline unless it ties up with somebody else.
And she made clear she sees a regulatory distinction between this and JetBlue and others out there, in that this is, it's not T-Swings, but these are smaller entities, including the acquirer.
Although she did say, by the logic, that they should approve both of this merger, they should also approve the Spirit and JetBlue one. I also wanted to point out Spotify, which I know is your favorite company in the whole world, but I did want to just point out, I do think it's interesting that the shares are up 6.4% after announcing almost a fifth of their workforce will be laid off, cutting office space. Just a real question around whether this is a specific story or whether there are some broader implications the way that they tried to signal.
I don't know what it means other than it's about streaming and the rest. I think that Warner Discovery's trying to sell a movie music catalog to somebody and can't get it done because the valuations have changed, and that's all this mix of Apple Music, Tidal, Spotify, and the rest. Is it a money-making business? And that's really the arch debate into next year.
How much can you get people to actually pay? I want to pick up on what Gennady Goldberg was saying of TD Securities last week, where he said, it just seems like people have gotten a little ahead of themselves. Peter Scheer talking about, similarly, November as an incredible year, head of macro strategy at Academy Securities, an incredible year that may or may not be repeatable in the coming year, that is December. How much do you lean against some of the moves that we saw last week, Pete?
So one, I'm starting to lean against treasuries a little bit. I think 420 is a little bit too low given the data. I don't like the fact that either 10-year real yields are right around 2% or five-year break evens are back to right around 2%. And if last month's Fed meeting was really about the market had done the work for the Fed, this month's meeting is going to be about, well, the market undid all that work. So I think rates have got ahead of themselves. On the equity side of things, I think we've seen for the last couple of weeks this move where the Russell 2000 disruptive stocks have outperformed some of the broad indices. And I think that actually continues into year end.
Peter, you're so good at use of cash, and I want to go to the use of cash right now of one Mr. and Mrs. Zuckerberg. Bloomberg reporting on the sale of the Zuckerbergs, of a very large amount of Facebook shares. It's a little bit smaller than what Peter Scheer has in Meta, if you will, but they are out right now with some news on that. And Peter, I think this does get to use of cash. It gets to dividend increase. It gets to share buyback, and maybe executives unloading their stock after, in this case, 172% surge. Peter, help me here with where we are in use of cash if we see people like the Zuckerbergs selling shares.
Listen, I think we've had this phenomenal run in the Magnificent Seven. The leadership has been very narrow all year. People have been talking about that. And since November 9th, and we brought up, I think, last week, NVIDIA earnings were very telling as well. NVIDIA earnings were probably fine. Stock went down, but markets rallied. And I'm really looking, the disruptive stocks are doing well. You see Spotify up there today for various reasons. I think you're going to see regional banks continue to do well, commercial real estate, Russell 2000, all the small caps, all the things that people have left behind as people are trying to figure out where do I put my cash right now, especially if you missed 5% on the 10-year. Those kind of look interesting. I think have some momentum coming into year end.
I'm actually fascinated, Peter. Let's meld the two together. I mean, are we going to see bond issuance to support equity ownership? I mean, whether it's the miracle of Zuckerberg's and Facebook up, Meta up is well. I mean, I think it's almost a jumble into next year.
Yeah, I think we are going to see more bond issuance. If we've been certainly talking to some of our corporate issuers recommending that they get out ahead of this, right? We were at 5% on 10 years. We're at 4.2%. You can save some money there. Credit spreads have actually done very well. We're at the lowest spreads all year. So issue some bonds, support your equity. Also, I think we could see some M&A activity finally start picking up. It's been, looked at the end of the summer, you might get a bit of that, but now you've had the stability reasonably long enough. I think you get some interesting transactions done coming into the new year.
A phrase from 12 months ago, and Lisa, I give you, you coined this. It's almost a toxic brew of risk on is where we are.
Which is the reason why a lot of people might say it might have gone too fast, but it's hard to lean against. Peter, just to Tom's point, the news is that Mark Zuckerberg is selling Meta stock for the first time in 2 years. And this comes after the incredible run up, and you're seeing the shares in pre-market trading down about 1.5% on Meta. It raises this larger question of what do you lean against? You said you think Treasuries rates have gone too far. A lot of people, I think, are starting to pick that up, which is maybe why you're seeing a bit of a retracement today. On the equity side, are you hearing anyone lean against some of the tech names that have gone incredibly far so far this year, and frankly, the year that was November?
I'm not sure if many people are actually leaning against them. I think it's still a fairly crowded trade to be long those, but I would be very comfortable being short QQQ, so the NASDAQ 100 versus long IWM, the Russell 2000. I think trades like that are actually well positioned for the next few weeks. And at some point, I do think we probably want to turn bearish on this market. Maybe we get to 4650 on the S&P 100 versus long IWM, the Russell 2000. I think trades like that are actually well positioned for the next few weeks. And at some point, I do think we probably want to turn bearish on this market. Maybe we get to 4650 on the S&P. Maybe the Russell 2000 can run another 5%. But if the economic data starts coming in as weak as probably needs to be to support 420 10 years, then I think equities are going to roll over a little bit. But that's probably not this week, next week. That's probably closer to the end of year, early January.
So how would Russell 2000 outperform NASDAQ in that scenario, right? Because at this point, if you start thinking about weaker economic growth that supports the bond call, why then would some of the most levered to the economy companies, the smaller companies, do the best?
Because I think people have been avoiding those stocks all year long and crowded into the other stocks. So it's all going to be about what's crowded, right? And if you start getting nervous about the economy, people are going to turn around and say, oh, we got to cut our risk. Well, guess what? If you don't own a lot of Russell 2000, you can't sell the Russell 2000. So you're going to wind up selling what you have. And I think that's just the nature of this market right now. That's the crowded trade. That's where people piled into. So if we get nervous about the economy, that's actually going to sell off harder because that's where people are overweight.
Peter, where's 60-40 12 months from now?
No, probably where it's always been. It's kind of has this attraction. That's one of the things that kind of just keeps on going, along with covered call writing. People like those strategies. I think you want to be probably underweight treasuries right now on that 60-40. You want to be more towards the front end because I think the next move should be slightly higher in yields back to 440 maybe on 10-year. But you still want to play around that. You want these balanced portfolios, and you want to also see what can we do outside. I actually for the first time in multiple years for the last 2 weeks, and it hasn't been working yet, I like Chinese stocks more on a trade. I think long-term, I don't want to invest in China, but for a trade, they're fair.
You know, Peter, thank you so much for the comments, particularly there on Meta as a Zuckerberg's unload stock as well. Nobody's talking about use of cash. 12 months ago, it was religion. 24 months ago, it was gospel. Everybody talked about it. And to me, this use of cash in the different ways it can move, what CEOs do, what principal owners do, what companies decide to do with the cash that's out there, I think is underplayed right now.
Are you talking about corporate investment or are you talking about individuals?
Both individuals. Bond issuance. I'm fascinated to see if Magnificent Seven finally do mega gajillion dollar bond issuance again. I just don't know if we're going to see it. But there's the Zuckerberg stepping in after what? Up 172%?
Yeah, 2 years. 2 years since he sold stock.
And that's a rounding error. That's out of the piggy bank, right?
Well, so this raises this question. Does he see something that we don't? Which is maybe why you're seeing Meta shares down by almost 2% now after this news was released in pre-market trading. Perhaps people scenting, maybe he thinks it's a good time to cash out. I mean, otherwise, what would really spur such a significant move?
Well, much more on that. Look to Bloomberg Technology on Bloomberg. Edward Ludlow, Caroline Hyde as well for further discussion of this news on the Zuckerbergs and their selling of Meta stock. Futures negative 24, the VIX 13.39. Friday, jobs day. This is Bloomberg. Good morning.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
After 5 weeks of gains on the S&P 500, pulling back just a touch. Live from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, equity markets on a 5-week winning streak as bond markets steamroll. Chair Powell's caution, rate cut bets push gold to an all-time high. We begin with the big issue, selective hearing.
We've been engaging in a lot of selective hearing.
Markets are hearing what they want to hear.
We see in the bond market, they don't really believe the Fed yet.
The market is misinterpreting some kind of enormous Fed pivot.
Markets have now priced in over 4 rate cuts next year.
This belief that the Fed is done and that rate cuts are around the corner.
Powell's message, I think, is pretty clear.
Powell has been very consistent in his remarks.
In line with things that he said previously.
He has said, let's just calm down.
He still has a strong bias to continue fighting inflation.
Chair Powell is really determined to keep inflation down.
They're looking for material economic slowing.
The idea that they're going to quickly cut is something they want to push back against.
The market is desperate to get a directional view.
I think patience is the word.
This will go on for months in terms of when we really get that clear signal that the job is done.
Starting the conversation this week, PGIM's Greg Peters, Sonal Desai of Franklin Templeton. Sonal, first to you, has this bond market got selective hearing?
I'm just looking at the facts. I'll just say one thing. Powell put financial conditions on the table. We, at this point, have unwound 375 basis points of rate hikes. We're back to when the Fed was at 175, middle of 2022, in terms of where financial conditions are. So, yeah, I think the bond market has got selective hearing. I think we are very much ahead of ourselves here.
Let's get into it, Greg. Just how much daylight is there between what the Fed is communicating and what this market is pricing? And is there anything specifically problematic about that?
Yeah, so I would say this is a continued theme, first and foremost, Jonathan. So, I mean, the markets have been fighting the Fed the entire time. The disconnect between what the Fed has been saying, putting in their dot plot, and being priced in the marketplace have been decidedly different. So this is not new. It's just now an extremist. So if you look at what's being priced in the market, it just is curious to me because to have so much in the way of rate cuts at this point, with a soft landing, it is really quite curious to me. So I think the markets have really pushed the envelope here to such an extreme that it's making it really difficult to be successful from an investing standpoint. So I think directionally is okay, but just the move has been so powerful, so much that you're really pushing it to such an extreme level in my mind.
Greg, take the move of last week, more than 40 basis points lower on a 2-year yield. That's a monster move, encouraged maybe by the words of Governor Waller, but as we've indicated, ignoring everybody else, including some important words from Chairman Powell. Greg Peters, when you look at moves like that, would you go as far as saying that the Fed has lost control of the bond market?
No, I don't think it's lost control. I mean, arguably, it hasn't had control the entire time. But it just speaks to the positioning and the lean around the market wanting and just really desiring rate cuts the entire time, right? If you go back to March of this year, I mean, during the SVB crisis, there was 200 basis points almost instantaneously, right? So that really gave you a sense of the direction where the market wanted to go. This is just a continuation of that narrative. So the market's looking for rate cuts at any chance it can get. And so I think it really matters very little what the Fed says at this point. The market wants rate cuts, and that's what it's going to price in.
I'm pleased you brought up the failure of SVB and went back to March. Last week, so now that was the biggest weekly move lower on 2-year yields since March. Back in March, as Greg indicated, we were pricing the end of the rate hiking cycle, but we were doing so for all the wrong reasons. Things were breaking. There is a belief now we can price in the end of the hiking cycle and start pricing in cuts for all the right reasons. Labour market's going to be okay. Disinflation's going to continue. Is that too idealistic? Is that an aspiration? Too dreamy for you?
It's beyond perfection, right? in the sense that what we are pricing to get the type of rate cuts as quickly, as early, and as massive as the market's currently pricing, which is close to 125 basis points, starting with a better than even odds for March already, you would expect a significant slowdown, at which point risk assets make no sense at all, right? Because you need to have a significant slowdown. I repeat, it doesn't all hang together. It is beyond perfection at this point. So one of the two probably is wrong. And I tend to think, given the speed of the move that we've seen in the recent weeks, that's likely where the floor is. So continued volatility, i.e. we see rates rally, and then we're probably going to see them sell off again. So this is in the beginning of nice, long, steady rally down, I would say.
This is all ahead of payrolls Friday. The numbers so far are about 180,000, a median estimate in our survey. Mike McKee can go a little bit deeper. Morning, Mike.
Good morning, John. Well, we're going to have, as you guys have been talking about, basically the statistical equivalent of angels dancing on the head of a pin over the next week or so as all of this data comes in and the Fed is quiet. Market will interpret things the way they want to interpret things. You can see since Chris Waller a week ago said that the economy was slowing down, that's what we're getting from the ADP, from the Atlanta Fed's GDP now numbers, and you can see the number of rate cuts priced in has followed that lower. Do we continue to see that? Well, the interesting thing about this week's data is that despite Waller saying the economy is definitely slowing, a lot of the numbers we're going to get this week suggest that it's going the other way. We have higher ISM services forecast. We have lower jobless claims forecast on a continuing basis, and Friday higher jobs. Now, the Friday numbers, Jen, you were talking about going deeper. The thing you have to remember, we got 180 in the number there, but we lost 33,000 UAW workers the prior month. So as they come back on, that leaves us at about 150, which would be about the same as we had seen. Then inflation watch, earnings are supposed to go up on a month-over-month basis, and a year-over-year basis fall. So what do you make of that? And then the Friday data, the last thing we get is the University of Michigan inflation estimates, and those are forecast to go down. So we could see a little bit of a stronger economy this week and a little bit of a weaker inflation outlook, and therefore we leave ourselves about where we were by the time this week ends.
Mike McKee, thank you, sir. Packed with data. Light on Fed speak. No Fed speak at all. We are in the quiet period going into next week's decision. Let's cherry pick some quotes. Governor Waller, something's giving. It's the economy. That's Governor Waller. Fed Chair Jay Powell, we're well into restrictive territory. Greg Peters, what's the evidence for that?
Well, I mean, you are seeing a slowing, but you're seeing a slowing off of extremely high levels. So this is not surprising that you are seeing some slowing in the economy. But if you look at the jobs report coming out or slated to come out on Friday, it still suggests a pretty robust backdrop for labor. And to me, all roads point to labor. You need labor to continue from an economic strength standpoint, of course. But the flip side of that is that since we're such a service-led economy where inflation is really driven by services at this point, it's really hard to envision an environment where you get back to the 2% level when you have such a strong labor market, given that services is such a large portion of PCE. So to me, it's a double-edged sword here, Jonathan.
Citi, say growth is tracking 2%. Payroll's coming in at 200K. That's their call for Friday. We just went through the estimates there, 180. And yet here we are, so now talking about being sufficiently restrictive and maybe a recession just around the corner. So now you say we still need to settle some massive questions. And I think one of them is where it's neutral. I'm not sure how we can say we are deep into restrictive territory without a decent understanding of where neutral is. So now, where is it?
So, you know, Jonathan, we've talked about this previously, and I tend to think that neutral is significantly higher than that 2.25, 2.5 the Fed has been talking about, because that implies a real rate of just 0.5%, assuming a 2% inflation level. And, you know, prior to the global financial crisis, over decades, that real rate was closer to 2%. Okay, so knock off 25 basis points. You still get to somewhere closer to 3.75% on neutral. Somewhere 3.75, 4% on neutral, upward sloping yield curve. Treasury shouldn't be where they are right now.
They've got an opportunity, Sonal, next week to do something about this in the dot plot, in their projections. Are you expecting that long dot to come up?
You know something? It's something I'm really curious about. I would expect that long dot to come up a little bit, but given the massive whiplash, every single thing that is spoken by the Fed gives the market, I think they would be smart to proceed with extreme caution in terms of what they're going to do with the dot plots next week.
Proceed carefully is the thing we've heard a million times. Greg, if you're given the opportunity to redo that dot plot, what does it look like?
Well, so I think that first and foremost, the dot plot is a cat herding exercise, right? So you have, all these different forecasts being thrown into the mix. So I think the efficacy of reading too much into that dot plot is overplayed. That being said, I do think neutral is a little higher here, but not as high as suggested. So I don't think you'll see much in the way of back-end rates moving higher in terms of the dot plot.
Well, this whole curve's moving higher this morning. Greg Peters, Sonal Desai, going to stick with us. Let's get into it. Talking of herding cats, look at bonds right now. Big move on Friday, pushing back against Chairman Powell's pushback. And then this morning, almost on nothing, up 10 basis points on a 2-year, 464. On a 10-year, up 7 to 427. Let's get into it and get you some movers going into the opening bell. Here's Abby.
Hey, John. Well, we do have U.S. futures to the downside right now. But first, let's look at two winners. And, of course, Hawaiian Airlines through Hawaiian Holdings absolutely soaring, up 174%, the best day in at least a year, perhaps ever. We'll have more data on that on the open. This, of course, on Alaska Airlines bid $1 billion to buy Hawaiian Holdings, and it will unite two carriers that largely serve the Pacific region. Alaska Airlines, as we will look at on the opening, down, though, more than 10%, as is usually the case for acquirers. Marathon Digital Holdings up 12%, with Bitcoin above $41,000 for the first time in quite some time. But take a look at Meta Platforms weighing on the futures. The NASDAQ 100 futures down more than the others, having to do with Mark Zuckerberg selling 185 million worth of shares in November for the first time in 2 years after the roughly 170% surge. Big outperformance to tech, right now heading to its worst day, perhaps since October 26th.
Abby, thank you. Meta making up almost 4% of the NASDAQ 100. Coming up on this program, Bitcoin rallying, gold touching a record high.
I've seen the gold move in different directions based on interest rates and based on currency moves. So it's very difficult to really ascertain, like, it's telling me something.
That conversation coming up next.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Gold is the worst thing I'm calling. To me, unless you hit somebody in the head with it, I don't know what you can do with it. I've seen the gold move in different directions based on interest rates and based on currency moves. So it's very difficult to really ascertain, like, it's telling me something.
Love Tony Dwyer, one of the best. Great to catch up with him a little bit earlier this morning as the everything rally moves beyond equities and bonds. Gold briefly shooting past the previous all-time high of 2,100. Bitcoin topping 42K, on track for its biggest annual gain since 2020. Both assets seeing sharp moves thanks to expectations the Fed is done and rate cuts could begin early next year. Let's get to the team coverage. Bloomberg's Simone Foxman and Isabel League joined us now. Morning, Simone.
Yeah, morning, John. But after gold hitting that record high against the U.S. dollar, it's actually retraced some of those gains down about 3% since then, and frankly lower than it started trading in Asia. Still up 12% this year. And so you have Tony Dwyer, you have the likes of John Stepek at Bloomberg questioning. Stepek says no one is entirely sure what's driving gold higher. Certainly part of the story is the end of the Fed's rate hiking cycle, with the markets pricing in that rate cut right now and interest rate swaps in May. But maybe it's partly de-dollarization. Maybe it's demand from wealthy buyers in emerging markets. Interestingly, check out this GTV Go, because what's happened in gold spot has not necessarily happened in gold ETFs. In fact, gold ETFs have been sellers for most of the year, with holdings down by more than 1/5 since 2020. These buyers, these gold investors in ETFs, have been driven previous rallies, and they are not there yet. We're still below inflation-adjusted highs in golds. Back in 1980, it hit 850, and that was equivalent to about $3,000 in today's dollars. But now we look at gold slightly lower than it began, and the likes of Barrick Gold, Newmont trading down in sympathy in the pre-market.
Simone, thank you. It's not just gold, of course. Isabel Lee, looking at the move in Bitcoin, having a look at 42K.
Hi, John. It did hit 42,000, which is the highest level since April 2022. But now it's pared back some of those gains, but still up. It's now at around 41,500. And of course, this enthusiasm is really fueled by the speculation that the U.S. SEC will approve a spot Bitcoin ETF by next year. And that includes from the likes of BlackRock. And of course, that the Fed is done hiking interest rates. So the last time this level was seen was around April 2022, when we saw the collapse of the Terra USD stablecoin. And if this rally holds, this will be the biggest yearly gain for Bitcoin since 2020. So it's going to be 3 years since then. And while 42,000 is a big round number, crypto investors are happy, it's still a far cry from the nearly 69,000 all-time high that we've seen a few years back. We're still around 39% from there. And if you look at Bitcoin's weekly relative strength index, so that's a momentum gauge, Bitcoin is hovering around overbought levels. So we'll see if this rally holds. But across the board, it's a green on the screen for the crypto universe. We have Bitcoin up, Ether up, Dogecoin also up, and Bitcoin Cash. And of course, that's really banking on the fact that there's a cross-asset rally, gold is up, and even assets in money market funds are also up, John.
What a move in Bitcoin year today. Simone, Isabel, thank you. Greg Peters, I want to come to you on the need for diversification, real, uncorrelated diversification, given that I think we've just had, according to Bank of America and Michael Hartnett, the best month for 60-40 going back to the early 1990s. And again, you see it on the screen this morning. Bonds down, yields up, stocks down too. Greg, if that's not going to break, where do you get that diversification from?
Well, so I think, in such a momentum-driven market, it's hard to get the diversification that the models predict over the short term. So, we take a long-term, medium-term perspective, and that's where the bond market really fits in. I think the real question on the table a few years ago, what was the value of bonds? What was the protective characteristic in a portfolio? So I think that's really changed on a go-forward basis. But, what happened last month, when everything rallied, it starts to break down. But I think you need to take a longer term perspective. And I really think that 60-40 type of diversification with bonds really starts to assert itself.
Sunil, do you agree?
I completely agree, because I think bonds are that medium-term play, and the bottom line is excellent diversifiers. And Beyond that, over the medium term, we're finally getting income again. It's been a long time, even with this massive rally that we've seen, which I don't think is going to stay. I do think we're going to continue to see real income coming from bonds, and that's important.
So now, what do you like in fixed income right now?
So, again, it's a difficult thing over the short term, but having said that, for some time now, we've been looking at this. I think probably the riskiest asset classes have rallied too much most recently. We do like staying shorter in duration, as we have mentioned previously. We went neutral, we've gone back to staying relatively short at this point. And I would say that going forward, we will probably be looking to stay higher in quality until we're more convinced that we are going to get some decent value out of risky assets. Right now, we think that the rally's overdone, especially in high yield.
Greg, are you on the same page?
Yes, I am. I'm very much on the same page. I think it's a high quality type of market. So you're not being rewarded to take a lot of credit risk in here. So we're definitely kind of higher quality, whether it's within the high yield market, the investment grade market we quite like, and portions of the structured products market. So it's not a time to take a lot of risk, Jonathan.
Greg, there used to be this story that credit leads. Do you still believe that credit leads?
Well, that was a story that the credit folks like to talk about. But I do think there is some rationale behind that. But, with the information transfer just happening so immediate these days, I think that lead time is decidedly shortened. And it's not a financing-led sell-off or rally. So I do think it's a little different this time, as companies have turned out their debt and they've locked in low cost of capital. So I don't think it's the same type of relationship that we've seen historically.
So now, just a final word from you on the same theme.
No, I would agree. This is in the current market that we have. It would be crazy to think that what the type of rally we saw last week had anything to do with fundamentals. It has everything to do with the speed of information flow and people reacting immediately to the potential of what that information holds. So I think it's very sentiment driven. I don't think this has very much to do with real credit or any fundamentals for that matter.
I can sense the frustration from both of you. So now does I. Greg Peters, to the two of you, thank you. High yield spreads, 374. It's not just equities rallying, not just bonds that have been rallying, it's credit as well. Corporate debt rallying big time. I want to turn to the broader markets. It's an unwind of some of the moves we saw last week. So last week, fifth week of gains on the S&P 500. This morning, pulling back on the S&P by 0.75%. The support over the last month or so has come from the bond market. This morning in the bond market, unwinding some of that move as well. Big move on a 2-year last week of more than 41 basis points, 40 basis points plus lower. This morning up by almost 10, up 9 on the 2-year, so back to about 463 on a 10-year maturity. Further out along the curve on a 10-year, up about 7 basis points to, let's call it, 427. On a 30-year, up around about 4 to about 443. Coming up on this program, the morning calls and later. Stifel's Barry Bannister seeing limited upside for stocks into next year. That conversation coming up next. Your opening bell is about 7 minutes away.
The acceptance of Puro-Sangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Puro-Sangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
Always on the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Okay, 5 minutes out from the opening bell. Here's the state of play. 5 weeks of gains on the S&P 500. Longest weekly winning streak going back to June, equaling that run. This morning, pulling back just a touch on the S&P 500, down by around about 0.8%. On the Nasdaq 100, a bigger move lower. So if the bond market gave the equity market bulls some comfort over the last week, it's maybe spooking them a little bit more this morning. Your 2-year last week down by more than 41 basis points. This morning, we unwind some of that. The 2-year up by about 9 basis points to about 463. That's the price action cross asset going into the opening bell. Let's get you some movers this morning and some morning calls. JP Morgan upgrading Carvana to neutral, $40 price target, reflecting better productivity and improving operations. That stock is up by 3.75%. Your second call from Wells Fargo downgrading Lululemon to equal weight, removing the stock from its list of top picks due to its expensive valuation. That stock is negative 1.6. And finally, Mizuho upgrading GM to buy, $42 price target, expecting shares to rally after settling its dispute with UAW. That stock is positive 0.6%. Coming up on this program, Stifel's Barry Bannister warning of a lost decade for U.S. equities. That conversation is coming up next. Your opening bell with equities at session lows is just around the corner.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Let's get your trading week started live from New York City this morning. Good morning. 20 seconds away from that opening bell. Equity futures negative 0.75%. What will it take to break that positive correlation between stocks and bonds again this morning? It's a reversal. Last week upside down, if you will. Yields up, stocks down. As your opening bell, switch to the board and get to the bond market. Yields look like this. Your 10-year up by 7 basis points. 4.2664, up more at the front end. Last week, totally the opposite. Yields down aggressively. Stocks doing well going into the weekend. In the FX market, the euro 108.25, pulling back by 0.5%. The dollar showing a bit of strength again, reasserting itself against the euro that's starting to think about rate cuts. Earlier on this morning, we caught up with George Saravelos of Deutsche Bank saying he thinks this ECB goes first. He thinks they should cut, not will, should cut next week. 108.24 on the euro and crude pulling back by 0.8%, 73.50 on WTI. 40 seconds into the session, we're down across the board here on the S&P. We're negative by 0.75%. On the NASDAQ, we're down by almost 1 full percentage point. One stock to watch at the open, Hawaiian Holdings. Alaska Air agreeing to buy the company in a deal worth $1.9 billion US. Abigail has more. Hey, Abby.
Hey, John. Well, with that stock up 184%, heading to its best day, not surprisingly, ever since going public back in 1995, investors are cheering the possibility that this deal will go through. Now, what is happening here is a 100-year, roughly 100-year competition may be about to end because, of course, these two airlines largely serve the Pacific area. So Hawaiian Holdings for Hawaiian Air has agreed to be bought for $1.9 billion, as you mentioned, in cash and debt, would basically unite these carriers. They would retain their separate brands, but together, according to the airlines, have a larger reach. Now, it will solidify Alaska Airlines' position as the #5 domestic carrier, but there could be potential antitrust action ahead. 80% of the domestic carrier airspace, of course, airline activity is owned by 4 airlines. Plus, recently, the Justice Department did file for the JetBlue and Spirit merger to not happen, and they succeeded in busting a partnership between JetBlue and American Airlines. Raymond James actually said that the combination could or would change the market's currently moderate concentration to highly concentrated. So on this, we do, of course, have Alaska Air down 18%. The acquirer, as you know, is usually down, but maybe it has something to do with these antitrust motions. Hawaiian, on the other hand, absolutely soaring. It had been into today, down more than 53%. I think now it's down probably less than 20%, maybe even less than 10%, John.
It over until it's over. Abby, thank you. Watch this space on that story. A developing one for you. Want to get to Spotify. Shares of Spotify this morning on the move after announcing plans to reduce its workforce by 17%. Ed Ludlow has the story. Morning, Ed.
Yeah, good morning, John. That 8% move higher puts it on track for its biggest jump since late October, but the stock trading at its highest level since February of 2022. This is the 3rd trim of workforce that Spotify will have done this year, but the deepest. 17% is about 1,500 staff. That takes the total for this year to around 2,000. What Daniel Ek, the CEO, said in his letter or statement is that they've considered doing sort of smaller reductions over a period of time, but decided that, quote, substantial action now was the right way to go. Remember, things aren't bad for Spotify necessarily. They're on track to add around 100 million users this year, which would make their best year for sort of subscriber growth. But profit is hard to come by. And when you take into account the one-time impairment charges tied to these layoffs, they're forecasting in the current fiscal 4th quarter an operating loss of 93 million euros to 108 million euros, reflecting charges of around 130 to 145 million euros. They were expecting operating income, positive income of 37 million euros before that cut was announced. So you know the story. They spent a lot on podcasts, billions of dollars, then they pulled back. I guess it's tightening the belt when times are good.
Ed, I said it this morning, cutting costs costs money. You've seen that with Spotify this morning. Ed, I want to talk about Facebook. I want to talk about Meta. Zuckerberg selling stock. First time I think in about 2 years. What's the takeaway?
Yes, it is the first time that kind of Zuckerberg Inc. has sold Meta shares since November of 2021, though I would kind of say that this is a story about philanthropy and charitable giving. So in total, it's 682,000 shares worth around $185 million, but it's through charitable and political entities rather than him selling himself. The timing's interesting though, right? Look at the year-to-date gain in Meta stock, more than 170%, and then remember how bad things were in 2022. Zuckerberg didn't sell any stock, even if it was for, would be for political or philanthropic purposes that year, because financials were very poor, investors were talking with their feet in terms of their response to his spend on the metaverse. The situation's improved, but again, I would just underscore, he has sold blocks of shares in the past. Remember that he and his wife, Priscilla Chan, have committed to give 99% of their wealth in their lifetimes for charitable causes, and that's kind of the rationale here, it seems.
Year-to-date move up by a phenomenal 162%. Ed Ludlow, thank you. Nothing to see here, maybe, listening to Ed there. The stock is lower by almost 3% this morning. I want to take a look at Uber getting a boost as the company prepares to join the S&P 500. Isabel Lee on top of this one. Hey, Isabel.
Hey, John, it's not just Uber. We also have Jabil and Builders FirstSource joining the benchmark gauge. Uber and Builders FirstSource are rising, but Jabil is kind of trading lower. I think it's probably because last week Jabil reported that it cut its first quarter revenue forecast, saying it experienced a softening in demand. But overall, inclusion in the S&P 500 is a positive for stocks because a spot in the benchmark index boosts the trading company's liquidity and it boosts their investor profile. So both factors usually prop share prices higher. And the three will replace Sealed Air, Alaska Air, and SolarEdge Technologies upon market open on December 18. I want to hone in on Uber, though. So the stock has rallied year-to-date 132%. Bloomberg Intelligence said that Uber's inclusion in the S&P is a stamp that it is the market leader. And for a few months now, investors have been speculating that Uber will be included, and now they finally are. The company has also been on a good run. It showed its second straight profitable quarter, and many expect Uber's business to continue to expand, John.
Up nicely this morning. Isabel, thank you. The stock is higher by a little more than 4%. Check out Virgin Galactic. The founder, Richard Branson, telling the FT that he doesn't plan further investment into the company. Let's get Simone on this one. Hey, Simone.
Yeah, John, this is sending shares down the most since June. Richard Branson telling the FT that we don't have the deepest pockets since COVID. Virgin Galactic has about $1 billion or nearly, and therefore it should have sufficient funds to do the job on its own. But this is seen as pretty bad news, especially considering that last month the company worked to save about $25 million by cutting 18% of its workforce, discontinuing commercial flights for 18 months, and then also all of this trying to funnel money into its new Delta space plane. Last week, Morgan Stanley was talking about that news. They downgraded their price target to $1.75. Just a complete lack of catalysts that was their rationale behind that. Wall Street believes the company will have to ask for more funding by 2025. Branson says through 2026, it should be pretty well funded. He says he's still loving the company. It's really proved itself and its technology, and he remains one of the largest shareholders. But considering the collapse of Virgin Orbit earlier this year, that's the rocket startup, I think there's raising a lot of concerns in the market. We're looking at shares now down over close to 13.5% and down over 40% this
Brutal. $2 stock, $2 name. Simone, thanks for that. Thanks for the update. About 8 minutes into the session, here are the scores right now on the S&P 500. 45.66 on the S&P, up by 0.6% on the session. On the NASDAQ, up by around about 0.9%, down by around about 0.9% on the NASDAQ 100. A negative day here largely across the board, with the exception of the small caps. The Russell there, just about positive by 0.2%. It is outlook season on Wall Street. You're familiar with that now as crystal ball type stuff. It's time to look into the crystal ball of Stifel. Barry Bannister expecting limited upside for stocks, writing this. We see the S&P 500 topping out at roughly 46.50 midway through next year as mega cap growth loses some ground to cyclical value as a result of economic growth, inflation, and Federal Reserve tightness, all proving resilient. Barry, I'm pleased to say, joins us now for more. Barry, always great to touch base with you, sir. Great to catch up this morning. Thanks for being with us. Barry, let's talk about the recent rally first. What have you made of the last 4-5 weeks in this stock market?
Well, on Halloween, October 31st, we wrote a note saying the S&P would go to 44. It obviously overshot that, but we were positive going into year end. But what we're seeing in the market in the next 6 months is more of a rearranging of the deck chairs. As the economy, the growth proves persistent, the inflation proves sticky, we're actually saying that the cyclical value, the banks, cap goods, energy, financials, materials, transports, real estate, they would gain ground, and some of these mega cap tech would lose some ground on the price earnings multiple. And as a consequence, the market doesn't have a lot of upside.
Would you expect the bond market to reprice on that better data as well? And just to build on what you said about sectors, which sectors would tolerate that best?
That's just it. More of a positive economic growth, perhaps a higher PMI manufacturing. We're looking for 53 on that index. Pickup in industrial production, durable goods. Generally a strong economy. You know, it's not particularly robust in historical terms, but it's better than what was expected, not just here, but abroad, China and Europe. I go for the more deeper cyclicals. The cyclical growth names like the Apples and Nvidias of the world are pretty pricey. And I think what you do is see a rotation in the market. Not good for the cap-weighted index, but pretty good for investors who pick the right industries and stocks.
Barry, I wonder where that would leave the banks, which seem to be rallying on lower yields as much as they sold off on higher yields, which is like an upside-down world. Not the world we're told about, not the world you and I have been used to over the years. Barry, where would that leave bank stocks?
Well, some of the horror stories with real estate are probably overdone in terms of the bank portfolios. The banks are also extremely well reserved. They're practically regulated utilities now. And I would argue that there's an oversold condition in the banks as the economy holds on because of a foreseen view that the loan loss reserves will not have to go up. There may even be releases back into earnings. So I think the banks would benefit from this. Again, we're talking about a trade, a rotational trade in the market within the context of a market that doesn't really go up much.
Banks had a decent week last week off the back of that bond market move. Barry, let's wrap things up by looking back before we start looking forward. When you start to say things like the growth can remain resilient, inflation can remain sticky, and that means tech maybe struggles, equal weight S&P over market cap weighted S&P, I think that makes a lot of sense to people, just as scenario analysis. But Barry, when you look back on the year, where growth has been pretty decent, yields have been higher, and yet tech stocks have managed to tolerate all of that and a whole lot more. Barry, what's your understanding of what's happened in the last 12 months, which makes you think it might be different in the next 12?
Well, the one thing that we probably could have caught and understood better was that after a 10-year period of prosperity for the technology sector as a whole, remember Meta's year of efficiency, well, what were they doing the prior 10 years? So what those companies did was cut costs. They had built up a lot of fat, just like a person. They were able to lose that 10 pounds and keep those margins up. That had a lot to do with the earnings resilience of tech. And then, of course, the recent view that the Fed has done has helped the price earnings multiples. But I wouldn't get carried away with that. This Fed is concerned. This Fed has higher inflation right now than it's comfortable with. And they're in no hurry to cut, despite what the bond market's perception was.
Do you think we've seen the end of that cost-cutting exercise in Silicon Valley? Spotify this morning, 17% of the staff is going, stocks up 11%. To your point, the discipline that came through from Meta, that stock is up by 163% year to date, and some pretty decent top-line growth in there as well, Barry. Are you saying we've seen the end of that effort?
Earnings are great, but to be honest with you, the stock market itself aligns very closely with the growth rate, the 10-year growth rate, compound annual growth rate of the price earnings multiple. It's really a macro question of what's your multiple outlook. And one of the biggest changes in the market, the single biggest change, I would say, and of course the thing that most tightened the Goldman Sachs Financial Conditions Index in the last 2 years, was the Fed normalized the 10-year real yield, called the TIPS. That went from a minus 1.3 to a plus 2.3 at one point. And as a consequence, you had negative convexity. You had a price earnings multiple compression of the market. I don't see the Fed wanting the TIPS yield to to go down dramatically. I think they've normalized it because inflation at some level is back. And so a more normal TIPS yield will keep a lid on price earnings multiple growth and thus keep a lid on S&P returns.
Interesting. Barry, we've got to leave it there. Appreciate the outlook for 2024 from Barry Bannister there of Stifel, looking out to 2024 with limited upside on the market weight S&P 500. About 14 minutes into this session, these are the scores. We're negative 0.6% on the S&P. We're down about 1 full percentage point on the NASDAQ. If you go into the bond market, there is a Y out there in fixed income. Yields are up across the board here. I'm not sure why they're up, though. We're up by about 9 basis points after a big move last week lower. The 2-year back to 463, the 10-year getting back to about 427. Coming up on this program, it's Merger Monday.
For Alaska and Hawaiian specifically, it really will help them cross the bridge to the other side of the river, so to speak, where they'll be able to survive as a consumer brand.
A $1.9 billion deal in the airline space. That conversation up next.
When you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
World of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power.
Balance of Power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
I'm a conservative, but I'm not in a bad mood about it.
Fellow governors. Bad mood about being conservative? Is that because you feel like populism has taken control of your party?
And Joe Matthew.
What is it about race that bothers you about the new chairman of the Joint Chiefs?
Our military is becoming so political that we're going to go south when it comes to readiness.
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most. It's not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg. Context changes everything.
Alaska and Hawaiian specifically, it really will help them cross the bridge to the other side of the river, so to speak, where they'll be able to survive as a consumer brand. During the pandemic, we didn't have the consolidation we probably should have had. We had the government stepping in to save the airline industry. And unfortunately, they couldn't save everybody. So now you're getting that washout.
Seeing some consolidation now. Merger Monday living up to its name. Alaska Air announcing plans to purchase rival Hawaiian in a nearly $2 billion deal that could provide a valuable lifeline to the struggling Pacific airline. In the pharma space, Roche joining the obesity drugs gold rush, snatching up Carmot for $3.1 billion, threatening to push the Swiss company into competition with Novo Nordisk. Your team coverage starts right now. Sam Fazeli in London, George Ferguson in New Jersey. George, straight to you. The line that we got from Alaska today, we are pro-competitive, pro-consumers. Do you see good reason for this deal to close?
So look, from a regulatory standpoint, I don't see any reason why this deal wouldn't close. Hawaiian's a very small operation. For Alaska to put it into its fold, I think is going to be a big deal. From a business standpoint, I really don't see why this transaction should occur. It doesn't really change Alaska. I think, it adds a little bit of Asia to it. It adds Hawaii, which they already have some exposure, as inter-island, which they don't have exposure at now. It adds flights into Japan from Hawaii, into Australia, into other parts of Asia, but it's very small, wide-body, long-haul operations. But really, if they want to be a big airline, if they want to be a full-service global airline, there's large gaps, and so this doesn't really get them, to any, I think, different place besides a more complex operation. It does save Alaska because Alaska has a lot of debt to refinance. It would come at very high rates, high teens, and so to me, it looks a bit transactional, not so much transitional.
So there's one deal that may not take place as well that we need to talk about. George, what is going on with JetBlue and Spirit?
The trial's been going, right? And so the sense I get, and I'll tell you, our litigation analyst, Jen Ree's been following it very closely. And the sense I get from her is that the government really hasn't made a very good case. And so Jen and I think, are of two minds of this. I always said that deal would get done. She thought maybe it wouldn't, but she said now it doesn't look like the government's made a great case. And it looks like that transaction could get done.
Here's a deal that is getting done as well. Roche, Carmot, $3.1 billion. Sam Fazeli, let's talk about it. It seems to me that you're either in this effort, obesity drugs, or you're not. And if you're not, your stock is struggling. If you are, you're booming. Is that the case?
Well, I hope that's not really the case, because these pharma companies do a lot more than just obesity drugs. But from the outside, when you look at it, John, I think you might think that that's what every pharma company needs to do to get their share price running. And you look at it today, Roche's stock is up about $5 and a bit billion, and the value of the deal is about $3 billion. So something's working. Obviously, I'm connecting two things together where I think there's a lot more going on in the market than just this. But let's not forget, Roche has been around these drugs before. This is not the first time they're touching these GLP-1s.
We were talking about how transformational a deal might be. We were talking about the airlines. How transformational might this one be, Sam?
Yeah, a long way to go. We've only ever seen early data. The weight loss is supposed to be something that you need to maintain for 6 months, a year, 2 years, etc. We've talked about that. And also something that you need the longer term data to know about the side effect profile and whether the drug is actually better than anything else on the market, which is what the company is suggesting. So very early days. We've only ever seen really phase 1 data, so you can't really call it transformational.
Stock is up this morning by more than 2%. George, Sam, appreciate the update. It is well and truly Merger Monday. Let's get you some sector price action. 22 minutes into the session. Let's say good morning again to Abby. Morning, Abby.
Good morning, John. And we do have the S&P 500 down more than 0.5%. So not surprisingly, the sector composition is a little bit more negative than not. And what I would really like to highlight, take a look at communication services down 1.6%. But we also have tech down 1.6%. Microsoft, NVIDIA, Apple, all lower. Now, speaking of communication services, on this news in part that Meta, Mark Zuckerberg is selling shares for the first time, or did sell shares for the first time in about 2 years. We have the communication services down 6 out of 7 days over that time period, down about 5%, basically the worst stretch since October. And take a look at that cliff dive on the day on that Mark Zuckerberg selling his Meta shares, some of his Meta shares news.
Amazing. Abby, thank you. 23 minutes into the session, negative here by 0.5% on the S&P 500. Coming up, a sneak peek at a calendar for the rest of this week. Your trading diary up next.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Minutes, almost 26 minutes into the session, pulling back just a touch. As we say here a lot, no drama so far this morning. Negative by about 0.6% on the S&P as yields climb across the curve, reversing some of Friday's move. That's the price action. Let's get to the trading diary. The calendar through the week looks like this. Tuesday, we get US PMIs and JOLTS data. Wednesday, US bank CEOs testifying before the Senate, plus the fourth GOP presidential debate. Thursday, another round of jobless claims. Friday, it is the payrolls report coming up on Friday. I've been through the estimates a few times. 180,000 is the median estimate in our survey so far. From New York City, that does it for me. Thank you very much for tuning in Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We have red on the screen, the S&P off 0.7%. Coming up, we're going to check in with Bobby Ghosh. He's a columnist for Bloomberg Opinion, a real expert on the Middle East. He's going to give us the latest on what's coming out of Israel. Our C-suite conversation today, it's a good one. Brad Jacobs, Executive Chairman of XPO Logistics, New York Stock Exchange listed company. XPO is a symbol. To discuss kind of what's happening in the logistics business globally. And then we're going to talk to Ashley Carmen, reporter at Bloomberg News. She covers the audio industry. So we're going to talk about those Spotify job cuts. It's not very often you see a big tech company, a growing tech company, cuts so many jobs, in this case, 17%. We'll get the latest reporting there. We're going to kick things off right now with John Tucker and a Bloomberg Business Flash.
All right, big week for data, so let's start right there. Just getting, and I'm going to call this Fed-friendly right out of the gate. Factory orders down 3.6%. The prior month also revised downward. And durable goods orders, we're going to define this as stuff that hurts when you drop it on your foot. They were down 5.4%. So that's in line with what economists surveyed by Bloomberg were looking for at this point. The immediate reaction, the 2-year yield, that's still up 6 basis points. That's at 460. Now, after investors latched onto what they thought was a dovish tone from Fed Chair Powell on Friday, stocks, they continue lower this morning. S&P 500 down 32 points. That's a decline of 0.7%. We're at 45.62. The Dow Jones Industrial Average down 127 points. NASDAQ 100 down 187 points. The economist Dennis Garvin continues to push back against the idea of Fed rate cuts anytime soon.
He wants to keep rates at the level that we are right now. I've said for a long period of time, it's not higher for longer, it's high for longer, and I think he's in that same stream of thought that he'll keep rates. I think he keeps the overnight Fed funds rate trading at 5.25 for a long period of time.
And right now, Alaska Air, the worst performing stock in the S&P 500, as it plans to fork over $1.9 billion for Hawaiian Air. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and the minister
yes.
at the altar of equities.
That's
Jess
right.
Minton.
There's another one coming up this next weekend. I'm going to be officiating for
another. So this stuff is legal. Like, I think I'd walk in, like, if it's not working out and say, hey, we're not really married. I mean, it was just Jess Minton.
It was just Jess.
It wasn't like it was a priest or a rabbi.
Hey, if you need to get hitched, let me know. I've got the power.
Do you charge or you do this gratis?
Well, the last two have been for free. They were my close friends, but maybe I should start a side hustle though.
Exactly.
After this.
Very good.
People cried. They laughed. I feel like I was pretty good.
So you write something?
Yes, of course. I do the intro. I do everything. Yeah.
Wow.
It's
all right.
But not just a stocks reporter.
Yeah.
I've got other skills.
All right. Very good. Jess Minton is joining me here for the next 3 hours. We're broadcasting live from the Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio. As John was reporting, a little bit of a sell-off today after 5 weeks of gains.
Yes, longest winning streak since June.
It was been a heck of a run during that month of November. Let's see what's happening underneath the hood with those equity markets. We welcome Carmen Reineke. She covers all the markets for Bloomberg News, and she's live here in our Bloomberg studio in New York City. Carmen, what are you looking at?
Yeah, good morning. So today, looking at Virgin Galactic first and foremost, that's ticker SPCE. It's down about 14% after Richard Branson said in an interview with the Financial Times that he doesn't plan further investments in the space tourism group. He added that his business empire doesn't have very deep pockets since the COVID pandemic and that the company should have enough funds. Last month, Virgin Galactic said it would trim its workforce and pause space flights from mid-2024. That's to cut costs.
He's saying he's not going to invest in this company anymore. So why? My first question, if he's not going to invest in this company, is like, well, why should I?
Yeah, I think that's a great question. I mean,
Is he claiming, like,
I think he's saying that I think he's saying that, you know, the company has enough money to continue going on its own. You know, it's focusing on a new launch vehicle. It's had space flights this year. But certainly, yeah, cause for concern after the founder saying, and Richard Branson saying, I'm, you know, not going to invest anymore in this.
That is a very odd announcement. I can't remember seeing one like that before. But anyway.
So elsewhere elsewhere in airlines, Hawaiian Air, ticker HA, it's up 184%. This is a record intraday gain after rival Alaska Air agreed to purchase the carrier for $1.9 billion. This deal means that it will hold over 50% of the Hawaiian airspace, which I think is really interesting. Analysts say it makes a lot of sense, especially for Alaska International, gives it access to the One World Airline Alliance. However, there could be regulatory pushback. Analysts also citing JetBlue's proposed merger with Spirit Airlines, and also to be noted that Alaska Airline is down almost 70% on this news today. That's ticker ALK. So yeah, another really big top name merger in airlines.
Yeah, I just can't see the regulators. I mean, well, I don't know. It's just been, they haven't been looking at it, and it's down 17% today. Alaska Air, 17% today on the news, so the market does not like that either.
No. So another record intraday jump we'll go to next is iPoint Pharmaceuticals. I feel like there's not a day when we don't have some record from a biotech, and this one is up 230% after saying a mid-stage trial of an investigative therapy for eye diseases met all primary and secondary endpoints. Even with this jump, I think it's good to note that this is only the highest level for shares since November 2019.
Wow.
I know. Kind of interesting one there. And then I think we have to talk about Spotify.
Yes.
Yeah, it's up right now about 10%. It obviously announced this morning that it would cut 1,500 jobs, or about 17% of its workforce. Analysts say that this should help with its margins, and the company also cut its operating loss guidance for the fourth quarter. I think the interesting thing here is that the CEO is saying that the company is spending too much and that he's worried about an economic slowdown and the rising cost of capital.
That's interesting, because I mean, I'm just looking at the FA function on the Bloomberg terminal, and Wall Street, in terms of the analyst projections, actually have the company turning a profit for the first time in 2024.
Exactly. I mean, and that's pretty major, right? And so it's interesting to see that from leadership, you know, they're worried about, you know, being leaner and being able to make it through sort of the next phase of the, you know, economic backdrop.
We saw that a little bit with Meta last year, or actually this year, this calendar year, 2023, where he said, maybe we're going to scale back on some of our investments, we're going to pull back, and we're going to really focus on costs. Boom, the stock just ripped. And I think
Exactly. There's two big tranches of job cuts starting at the end of last year, and then again once in the spring of this year.
Yep.
Yeah, that's the thing. I mean, Wall Street likes it. I mean, we'll see what happens next.
I mean, its stock is up more than 150% for Spotify this year.
I remember back when I was covering these things, we just wanted top-line growth, baby. That's all we wanted.
Top-line growth.
Sub-growth. I don't care how you define it. We just wanted top-line growth. Now the kids want profitability. I just don't figure it these days. All right, Carmen, thank you so much for joining us. Carmen Reinke, she covers all the markets for Bloomberg News. She joins us live here in our Bloomberg Interactive Brokers studio. Want to get to the latest reporting on what is happening in Israel. It seems to be some, you know, I mean, Israel is, now that the ceasefire, if you will, is over there, back, it seems like, with a vengeance again. Bobby Ghosh joins us. He's a columnist for Bloomberg Opinion. He joins us as well in our Bloomberg Interactive Broker studio. I guess Israel's doing what they said they were going to do, Bobby, which is when this ceasefire is over, we're going right back aggressively. But it feels like there's some pushback, even more so every day.
Well, there's certainly a lot of pushback from the Biden administration. The Biden administration has been expressing concern right from the get-go about the scale of the civilian casualties in Gaza. There's also been concern that Israel has not yet, after all this time, articulated a day-after plan.
Okay.
And there was some hope that during that truce, Israel would have had the time to think some things through, have a longer discussion with the Biden administration, and come up with some plans, and also come up with a way to reduce civilian casualties. So far, we're not seeing any sign of either of those things. And there are serious voices in the Biden administration that are now speaking up openly. So Defense Secretary Lloyd Austin over the weekend saying that, look, if you know, and this is a man who knows from war, he's pointing out that civilians are the center of gravity, and if in this kind of a conflict, and if you lose that center of gravity, and he used these words, it's a strategic defeat. Now that's very strong language coming from a military man, and that's the strongest language that a Biden administration official has openly used to express concern about Israel and what it's doing.
Well, talk to us about the latest Israeli military strikes against Hamas in southern Gaza. What potential repercussions could there be, especially when you are talking about potentially more civilian deaths?
So in the first phase of the war, Israel asked people from Gaza to move from the north to the south, because Israel was going to focus its military activities around Gaza City, which is in the north, which is where it said that the Hamas fighters and Hamas leadership were. Well, you know, hundreds of thousands of Palestinians were forced to leave their homes. Many of their homes were destroyed, and they went to the south. So now you have a concentration. But guess what? Hamas hides among civilians. That's always been their MO. So a lot of Hamas people just went south with the civilians. Now the north has been thoroughly destroyed. Now Israel says we need to get at Hamas wherever they are. They're in the south. Where do you send the civilians? They're trying to identify little strips of land within the south where they're saying now that those will be no-go areas for Israeli bombings. But guess what? Even if the Palestinians move into those little strips of land, Hamas fighters are going to go with them. That's what Hamas does. If you're going to try to defeat Hamas in this way, then you're going to continuously take a high number of civilian casualties. And that's not a good look for Israel. That's not a good look for the Biden administration, which has sort of embraced Israel.
It seemed during the ceasefire that it was having some levels of success in the sense that meaningful numbers of hostages were released.
Yes.
And so I'm wondering why, do we know why the government decided to halt the ceasefire and go back? Did they feel like they weren't going to get any more hostages, or just the cost of waiting was too high?
The calculation for the Israelis always was, can we have a truce? Can we have a cessation of hostilities just long enough to get enough hostages out, but without giving Hamas too much time to rearm, regroup, and become a threat again? And I guess, and we can only guess, that that calculation, basically that the grace period that Israel was prepared to give Hamas ran out. And they had to make, and I don't want to make light of it, this is a very difficult decision. The majority of those hostages now are Israelis. They had to make the calculation that from this point on, if we delay by any more days, Hamas gets stronger and gets to become a greater threat. And even at the risk of the lives of all those hostages, Israel felt it had to go back into the war.
What does the potential timetable look like for how long this conflict can continue? Because I would imagine it's very hard to gauge that right now.
So during the truce, there's some numbers that came out that were reported, suggested that Israeli military feels that in the first 6 weeks of operations, it killed between 1,000 and 2,000 Hamas fighters. That's out of 30,000 Hamas fighters. That's the Israeli military's estimation. That's a lot. And if you consider what it took to kill these 2,000, how many civilian casualties, how much destruction, how much damage to Israel's international reputation, you're talking about a very long, drawn-out conflict that could go on. And some Israeli political figures have openly said that this may take months, it may take a year. And it may require, at the end of all this, it may require an extended Israeli occupation of Gaza. These are not popular decisions. Israelis don't want that.
Well, where are we in terms of the support for Netanyahu and his cabinet and his prosecution of this war? Is there any cracks in that support that could threaten that type of outcome?
Not yet. So the balance for Israel is on the one hand, he's deeply unpopular. All the polling suggests Israelis want to see him gone. But that's not the same thing as want to force him out. This is a problem this is a question that all countries and communities that find themselves in a military situation, in a war situation, do not want to change their horses in the middle of the stream while you're crossing it. And that's the situation that Israel finds itself. And Netanyahu, by the way, is playing up that. He's making the argument that I'm the guy who's going to conduct, you're safest with me. I'm the guy who should be conducting this operation, and I'm the guy who will, when the operation is over, prevent the rest of the world from pressuring us into giving away too much to the Palestinians.
What's the latest that we've heard from the Biden administration on this?
The same as we've been hearing for a while, which is, where's your plan? What happens afterwards? Who gets to run Gaza after this is over? Now, there's an idea that the Biden administration is putting out that the Palestinian Authority, which currently runs the West Bank, that they should be running Gaza. I'm not sure anybody wants that. The Palestinian Authority has failed in the West Bank. It's a sclerotic, deeply corrupt and inept organization. They're having difficulty running the West Bank already. If they had the additional responsibility of, and let's not forget, running Gaza now will mean rebuilding and dealing with a highly traumatized and to some degree radicalized population. The Palestinian Authority has shown no capacity for doing anything like that.
I have to admit, I'm surprised that we haven't seen more instances where the Israeli military or the Israeli intelligence has in fact found some of these hostages and freed them. I mean, we haven't seen, I mean, Gaza's it's not like a big piece of land here.
No, but it is a warren of tunnels, and these are, as you would expect with Hamas, these are their crown jewels.
Yeah.
They are guarding these hostages like their most valuable assets. And so it's not easy to go in there, and it would require sending in more boots on the ground. Israel hasn't done that yet. The time may come for that.
And still, I guess the blame game for how did this even happen, and they're not having those conversations really in Israel these days.
No, and we are seeing more and more reporting, the New York Times did a piece over the weekend about the signals that the Netanyahu government deliberately ignored. They were warned over and over again. Their own intelligence, as well as their border guards, were telling the folks back in Tel Aviv, something's going on, Hamas is planning something big. Here, they even had some details of these plans, and they ignored it. Now, you know, far be it for us to criticize. We were caught cold on 9/11. We were caught. You know, this happens with countries. This happens even with highly industrialized, highly secure countries.
Right.
But usually somebody pays a price for this. A political figure usually has to pay a price, and Netanyahu hasn't yet.
All right, Bobby, thanks once again for your time. Bobby Ghosh, she's a columnist for Bloomberg Opinion. A lot of experience in that part of the world, and it looks like the situation in Israel is bad. It does not appear to be getting any better, so we will continue to have the full reporting there. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Good morning, Paul. The frenzy over weight loss drugs is sparking deal-making in big pharma. Swiss drug maker Roche is paying $3.1 billion for Carmot Therapeutics. It's a company with 3 weight loss drugs in the pipeline. Bloomberg's Eric Fanner has more on the rising competition in the obesity drug space.
In recent weeks, we've seen AstraZeneca get into the act. We've already had Pfizer. They're developing a pill. Of course, the big players are Novo Nordisk and Eli Lilly, which has followed it with another drug. So you've got at least 4 big ones. Others surely pondering it. I mean, it's just everybody's going for this obesity market.
Roche is up about more than 2.5%. Spotify cutting jobs again, this time by another 17%, or about 1,500 workers. Bloomberg G. Cantrell says it's part of a longer-term strategy for the company.
This is a company that has sunk billions into trying to diversify its business by also pivoting towards podcasts as well as their typical music offerings. And on top of that, they also need to commit huge amounts of financing all the time to the licensing of that music, to the music license holders. And so that's a critical part of the business.
Right now, Spotify is up about 8%. And from music streaming to movies and TV, Verizon customers, they'll be able to save more than 40% each month on Netflix and Max streaming. Now, if you're a member of Verizon's My Plan, you'll be able to get ad-supported services from the 2 entertainment giants under one bundle for just $10 a month, and that starts on Thursday. Right now, Verizon is down almost 1%, Netflix down 2%, and Warner Brothers Discovery down a fraction. Those are the stories we're following. I'm Lisa Mateo.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. After the biggest winning streak since June, stocks starting on the week, the back foot. 9 of the 11 major industry groups in the S&P 500 lower right now. Some investors asking if the markets have moved too fast, and with the November jobs data due Friday, that's given some reason for the bond market to retrace a bit until there's more clarity with the data. Right now, the more policy-reactive 2-year yield, that is 9 basis points higher. We're at 462. The 10 is up 6 basis points. That's at 425. Right now, the major averages have the S&P 500 down 35 points. That's a decline of about 0.8%. We're at 45.49. The Dow Jones Industrial Average, 124 points lower, and the Nasdaq 100 down 224 points. That's a decline of 1.4%. Oil lower amid continuing skepticism that the latest OPEC plus supply cuts will turn the market tide. Gold lower right now, does remain above $2,000 an ounce, and Bitcoin over $41,000 per token. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Jess and Paul.
All right, JT, thank you so much. We appreciate that. Jess Met and Paul Sweeney live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well. So that's the internet. Jess, I know you kids are familiar with that stuff. So head over to youtube.com, search Bloomberg Radio. We talk about serial entrepreneurs, and I got to throw our next guest into this category. Brad Jacobs, he's the executive chairman of XPO. You know that logistics company. XPO is a ticker on your Bloomberg terminal. New York
Stocks
Stock
up
Exchange.
more than 170%.
Not bad.
Year.
It's got a $10.5 billion market cap. All right, but before that, XPO, he was chairman and CEO of United Waste Systems. I'm sorry. Former chairman and CEO of United Rentals, and he is CEO of XPO from 2011 to 2022 before becoming executive chairman. So this is somebody who just can't sit still.
Quite the CV.
Brad Jacobs, he's in our Bloomberg Interactive Broker studio today. So Brad, I know you've got a new fund out there, $1 billion. I'm guessing most of it, if not all of it's your money. What are you guys looking to do with this new fund? What's next?
So only $900 million is mine.
Okay.
The other $100 million is from friends and family.
Okay.
The largest one being Sequoia Heritage.
Oh, nice. That's
and
a good
the family
friend.
being real family, like
yes,
my sister, my brother,
okay.
my niece, and my nephews. So we're taking that $1 billion and we're putting it into a small cap, about $15, $20 million market cap. Well, it was. It's doubled its stock price today, so maybe it's 30 or 40 million market cap now, called Silver Sun Technologies.
Okay.
And we're then going to spin that company back off to the legacy shareholders of Silver Sun. So in a few months when the deal closes, the Silver Sun shareholders will have their company back. They'll also get a $2.5 million dividend, and they'll get about a 0.3% share in my new company.
And your new company is going to do what?
Well, we haven't announced the industry yet. I wanted the market.
But you're going to use this public entity, this vehicle, to make an acquisition.
Absolutely.
So tell us what the acquisition is.
This company will be publicly traded.
Yeah.
It'll have $1 billion in cash.
Okay.
And we'll do the same playbook that I've been doing for decades. I'm going to consolidate an industry. I'm going to buy companies. I'm going to assimilate them. I'm going to improve them. I'm going to get synergy from them. I'm going to assemble a world-class team. I'm going to apply technology to improve the business, and we'll be off to the races.
So you've identified the company, you just haven't announced it yet.
That's correct.
So
Do
we
you
can
want to
tell
us? We've identified the industry.
You've identified the industry.
We don't have a company per se that we're about to buy, although we're talking to several of them.
Can you tell us what the industry is here?
Well, we'll play bigger than a refrigerator, smaller than a bread box.
So I got to get you back again in a week's time or something?
Something like that.
All right. So what do you look for? I mean, waste management, logistics. I mean, these things aren't sexy, but what do you look for?
I think they're sexy.
Yeah, well, they're sexy for your bank account.
Sexy means making a lot of money for shareholders.
That's right.
And at United Rentals, we got in, it was $3.50 a share when I started the company in 1997. And on Friday, it was over $500 a share. And XPO Logistics, when we started in 2011, the investors who came in with me made 32 times their money as of last year. So I consider that very, very sexy.
When you put it that way. So what characteristics do you look for in a business when you go to acquire? Because you remind me of a a guy, I'm going to have to think of his name again, who did this in the cable industry, the radio business, and then the entertainment business up in Boston. Anyway, what do you look for in a company or an industry?
So I look for very specific things. They've all been in industrial services. That's my background.
Okay.
I look for large industries. I look for industries that are hundreds of billions of dollars in size. I look for ones that there's lots of interesting companies to buy. It's not consolidated so much that there's not a whole lot to buy. It's still fragmented. And at reasonable prices, at multiples less than what we're going to trade at, so we get some accretion from what we're buying. And I look for an industry where it's not totally tech forward yet, and I can take our tech prowess and apply it to the industry to get an advantage.
So what industries do you see that have opportunities at this point?
You're not going to give up, are you? So stay tuned. I will definitely tell the whole world what industry we're going to consolidate, but not today.
What kind of capital structure do you think is appropriate today versus maybe when you did United Rentals, when you did XPO? Debt is not free anymore. Talk to us about that. Talk to us about maybe if there's any other external equity you need, can you get it?
So in the first instance, we'll be debt-free. We'll have $1 billion of equity that we're putting into the company, and we'll have no debt. Over time, to answer your question, I think 1 or 2 turns is probably a conservative way to approach it, given the world and the turbulence and the risky nature of what's going on in geopolitics. And in terms of it available, there's never any problem raising money if you've got a good track record and you have a good team and you have a good business plan. So I'm not worried about access to capital.
What do you think that tells us about the direction of the economy right now?
Well, I'm not going to give a prediction because my predictions have been bad the last year and a half. Like most everyone else, year and a half, 2 years ago, I thought a recession was coming, and no recession came. So I've withdrawn my conviction on predicting the economy. Having said that, I do see it being generally soft out there in Europe and in the United States. And I see it slowing. I don't see it picking up.
So in your investments, let's say what you're looking at coming forward, do you prefer to stay in the U.S.? Are you looking for a global business? How do you just think about geography? Because a lot of folks are saying, I can't go to China. Europe's the growth isn't there in Europe for me. How do you think about it?
Well, Asia has an extra level of risk because what's going on with China. So I'm not eager to get into Asia. I like North America a lot. I like the United States a real lot for all the obvious reasons. But I don't mind Western Europe. France, UK, Spain, Germany. These are great countries with big economies and the rule of law.
So what we saw during the pandemic was a sense of reshoring or friendshoring, that type of thing. Did you see that? Do you see that at XPO? And how does that change our supply chain? Because I kind of grew up in an era where it was all about globalization, more and more globalization. That seems to have stalled a little bit.
Well, it's stalled a lot. I see that more in our supply chain spinoff, GXO Logistics, which has about 200 million square feet of warehouses across 1,000 warehouses around the world. There, you've seen a lot of our customers who had big part of their supply chain originating in China migrate to Malaysia, to Vietnam, to India, to Mexico, back to the United States. So that's a trend that's probably not going to turn around. I think people want to de-risk being dependent on China.
And especially when it comes to the supply chains and what we just went through because of the pandemic, where are you seeing improvements and where are there still some lags there that are issues for the broader global supply chain?
Well, the supply chain has normalized quite a bit. It's not anything like it was a couple of years ago during COVID when it was hard to get anything and things moved very slowly and the prices were real high. To the contrary, the price of freight transportation and logistics in general has come down a lot. And its capacity, the availability of transportation is available quite a bit.
So what's the biggest challenge as you think about it? I mean, you're going to put some capital to work here. What do you think, just broadly defined, are some of the biggest challenges that you're going to have for, again, redoing your playbook, growing maybe through acquisition and so on and so forth? What do you think some of the challenges over the next several years for you?
The most important thing that has to be accomplished in any business plan, but particularly one that's going to be high growth and where we're aiming for the stars in terms of very, very high returns to shareholders, is people. You've got to assemble a world-class, real world-class, not even first class, a world-class management team that's hardworking, that's honest, that gets along well and plays well in the sandbox together, is super smart, very focused, really understands what they're doing, on top of everything. And if you can get a management team assembled that's got those kind of superstars, The rest, I won't say it's super easy because nothing's super easy, but it's relatively easy.
What's one of the top questions that you get from shareholders?
Well, shareholders are always thinking about, well, it depends which shareholders we're talking about. So there's two categories there. You have short-term and long-term. So the hedge funds and some of the high-velocity funds, they're very interested in the quarter, maybe the next quarter.
Right.
At the most, the outlook for the next year. But the long-only institutions who own 5, 10, 15% of a company and are owning it for several years, they're seeing way past that. They're not so interested in the quarter. That's interesting, but it's not the real focus. The focus is, how are you going to grow the business? How are you going to grow this business over the next 5 years, over the next 10 years? What kind of organic growth are you going to have? What kind of margin expansion are you going to have? What are you looking at in terms of return on capital? And what is the specific business plan and the levers we should watch in order to hold you accountable? Those are the kind of questions that the serious shareholders ask.
All right, we'll be paying attention. We'll be watching the Bloomberg Terminal to see that headline go across. Brad Jacobs, he's executive chairman for now of XPO, which is a New York Stock Exchange.
Not for now. I'm executive chairman.
Okay,
I'm staying.
He's got a new fund out there, folks. So keep an eye out on your Bloomberg Terminal to see what Brad and his team go for next. Brad Jacobs, executive chairman XPO, in our Bloomberg Interactive Brokers studio. We will certainly pay attention to what's happening there. Markets here selling off a little bit. Nothing really to write home about. Heck, we've had 5 weeks of gains there. S&P 500 off about 0.9%. We'll have more coming up. We're going to head right down to Washington, D.C. right now. We'll get world and national news with
Amy Morris.
Amy Morris. There you go. Bing.
All right. Thank you, Paul and Jess. Israel's military is expanding its operations across the Gaza Strip with the expectation of a coming ground invasion of southern Gaza. We talked with Bloomberg's Oliver Crook, who says this next phase is coming as international scrutiny has become more intense.
There is certainly a lot of pressure on Israel now, and particularly from its historic allies. We've heard comments over the weekend from Emmanuel Macron saying that the aim of eliminating Hamas will require a decade of war, and so that Israel's objectives need to be clarified. But we heard it from Kamala Harris, who was saying that too many Palestinians have died. Blinken saying that really there needs to be fewer people dying as this operation goes on.
Bloomberg's Oliver Crook there. The Biden administration also ramping up pressure on Congress over aid to Ukraine. The budget office says the U.S. will run out of funds to assist Ukraine by the end of this year unless Congress acts. Republican Senator James Lankford says he thinks a deal can be done by then with the funds tied to border security.
We're going to do this all together. That's been the agreement that, again, from the White House originally, it asked for all these things to be together. We have agreed to do all these things to be able together. We can get this done by the end of the year.
Senator Lankford was on ABC's This Week, which you can hear every Sunday on Bloomberg Radio. The White House is seeking more than $61 billion in Ukraine aid. It's part of a $105 billion emergency package. An update now from the COP28 climate summit in Dubai. In an interview with Bloomberg, Bill Gates says the world probably won't meet the Paris Agreement's goal of keeping temperature rise below 2 degrees Celsius.
No, we won't hit the aspirational targets. Well, you can do the math on 1.5, and even 2.0 isn't that likely.
Still, Bill Gates says he is optimistic the world can avoid becoming 3 degrees Celsius warmer than the pre-industrial era. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom. This Bloomberg Business Flash. Lots of red on the screen right now. We have 7 of the 11 major industry groups in the S&P 500 lower right now. Treasury 2-year yields, which are more sensitive to Fed moves, rising 9 basis points to 463. The Dow Jones Industrial Average down 154 points. That's a decline of 0.4%. The S&P 500, 43 points lower. That's down 0.9%. And the Nasdaq 100 right now down 279 points. That's a decline of 1.75%. George Saravellos at Deutsche Bank says, you know what, the everything rally we have seen does not have legs.
The last 3-4 months have been great from an asset perspective because you've had this bonds and equities going up at the same time. I think that's going to be very difficult to repeat itself for next year.
Shares of Spotify right now up 7.9%. They're cutting 17% of the workforce. Hawaiian Holdings surging after the airline agreed to be acquired by Alaska Air Group for $1.9 billion. That's cash and debt. You have Hawaiian Air up 180%. On the other hand, Alaska, that's down 15% right now. And waiting for the data this week, the Labor Department issues the November employment report in Washington Friday, and that could signal moderation. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Jess.
Thank you, JT. We appreciate it. And Paul, as we were talking about earlier, taking a look at Spotify, reducing its workforce by 17%, and the company's steepest cuts yet this year as part of an aggressive effort to shrink costs and drive profitability. If you look at that stock ticker symbol SPOT, up about 8% this morning, on pace for its best day since late October. If you look year to date, up over 145%. Who better to chat with us about the latest news with Spotify than Ashley Carman, reporter with Bloomberg News covering the auto industry, joining us on Zoom. Ashley, walk us through the latest with Spotify. What do we need to know here?
Yeah, so I mean, obviously the big headline, 17% of employees, 1,500 people. Really awful, really, really awful. It's the third cut this year. Spotify has really been under pressure from investors to cut costs, achieve profitability. Spotify invested heavily in the podcast space, and investors believed that bet was a bad one, and we're really seeing the repercussions of it into this year.
All right, so, I mean, the stock's doing great. I'm looking on the FA function of the Bloomberg terminal. Analysts are expecting this company to turn profitable in 2024. So it seems like the company's in good space. Do you feel like this is an announcement of coming from a point of strength or not?
It feels like it's coming from a point of strength, although it is surprising. It does make me wonder about the status of the podcast business. We've already seen them cut significantly in that department. They cut 2% of the workforce in June, primarily in podcasting. So it does make me wonder if that bet continues to just not pay off and they continue to recognize it, or if they think that they're just going to have to branch into new areas and that they'll have to cut costs to do so.
Talk to us about the issues they've had with losing money just in due to terms of when it comes to licensing agreements with music right holders.
Yeah, so they have to pay a substantial portion of their revenue to the rights holders, of course, because in order to have a music streaming service, you have to license the music. And of course, the labels want their fair share. So that has been a real challenge for Spotify, which is why it has attempted to diversify its business by moving into podcasts, and then most recently began offering audiobooks as part of premium subscriptions on its service.
Talk to us about the, I guess, the competitive environment here for streaming music. Just if you could set out kind of where Spotify fits in this. I'm not a big streamer of music, but, you know, I don't know. I mean, there's a lot out there. I mean, iHeart and everything. Just give us a sense of what the competitive landscape looks like.
Yeah, so Spotify is the largest streaming service pretty much globally. And they're independent. They are not tied to a tech platform, which their primary competitors are. So you have Apple Music, Amazon Music. You mentioned iHeart. I mean, that's obviously a big US company in radio. But their primary competitors here are Apple Music and Amazon Music. And those two really have the benefit of being tied to a tech company. So Spotify is trying to make it on its own as an independent and make the economics work, which is a challenge.
So do other players in the industry face similar issues to Spotify, or is it just more unique to that company given what you were talking about when it comes to another platform like Apple Music? When you're a part of a much bigger technology company, maybe you're more immune?
I think it could be that they're maybe more immune, but Spotify really came out the gate. I mean, they spent over $1 billion on podcasting. So they were the ones that made that huge bet and push on that space, which I think puts them in a really unique position. And I do think that they also have to diversify to survive, whereas it is possible that Apple Music and Amazon Music can kind of stay squarely focused on music and be okay.
How much of their business is subscription versus advertising, and where does the market feel like maybe the most growth can come from?
They've continued to grow their subscriptions, which quarter over quarter has just been a wild, amazing testament to the strength of Spotify. They continue to grow subscribers. The advertising business, they have free users, of course, and I think as they move into more developing countries like India, those users, of course, are going to potentially be on cheaper plans or free plans. So advertising could become a bigger part of the story, but really they are a subscription business and investors want to see subscriptions.
And this does come during a year where Taylor Swift had quite the momentum on Spotify. So how is it when you have someone that's successful on that, still maybe not enough to prevent Spotify from having to go through these different cost-cutting efforts?
Yeah, I mean, Taylor Swift, of course, super successful, Beyonce, Drake, all of them. But at the end of the day, Spotify has to pay royalties every single time someone listens to those songs. So they're not getting to necessarily benefit from that. I mean, they get subscribers and they make some money, but not enough to offset just the fact that people are obsessed with Taylor Swift. I mean, that's why that podcast bet where they don't have to pay royalties whenever someone listens to a podcast was smart. But the question is, can they actually build business around it, and is it working?
Right. So Taylor Swift is actually going to earn more than $100 million in Spotify royalties for 2023.
Is that right?
Yes.
Wow. Oh my goodness.
Raking it in there.
So where are we with the podcast business, Ashley? I mean, are they still committed to it? How do they phrase kind of how they're going to invest in that going forward? Because I know that was a concern, as you mentioned before, for a lot of investors.
They still have, at least prior to these cuts, they still had a podcast department that was dedicated to doing original programming. I think after these cuts, we'll find out more about what the state is of those shows. But really where I have seen the company focus has been on advertising. They really want to not only put podcast advertisements behind their own programming, but also behind their third-party partnerships with people like Joe Rogan and Dak Shepard, as well as people who use one of their hosting services. So that could be places like NPR, for example, uses their service. They put ads on their shows. So that has really been the focus moving forward for Spotify. And that was a newer goal. So I think we're still trying to figure out whether that's going to pay off.
We only have about a minute left, but do you see further job cuts coming in the next few months or the next year? Or do you think this will be limited to what we saw today?
In his blog post, the CEO, Daniel Ek, said that this decision was made to avoid further cuts in the next year or two. So that's where he's at with it. I would hope for the sake of the employees that's the case, because this has probably been a pretty traumatic year for them. But yeah, as of right now, that's kind of what we know.
All right, Ashley, thank you so much for joining us. Really appreciate it. Appreciate the reporting there. Ashley Carman, reporter for Bloomberg News, talking about Spotify. Again, one of the bigger stories today on the Bloomberg terminal, cutting 1,500 jobs. You take a look at the stock price, and it's been all over, but it's had, again, up,
Up over 145% year to date.
Yeah, but he just pull up the max chart here. I mean, it's obviously, well, it spiked and got up to $350, $355 a share, you know, back in kind of the beginning of 2021. So it's got a lot of work to retrace, so it's not near its all-time high, but it's definitely moving higher. And again, this is another tech story, much like Meta, where you're getting rewarded for cutting your costs and focusing on profitability, which was different from, you know, just several years ago when a lot of these tech stories were rewarded simply for growing top-line growth, whether that's revenue or even subscribers or anything like that. Now the metric has become profitability, kind of the way it probably always should have been. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Hey there, Paul. Shares of Hawaiian Holdings, they are soaring this morning as Alaska Airlines agrees to buy the company in a deal worth $1.9 billion in cash and debt. Bloomberg's Sid Phillips says they have one pretty big hurdle to clear first.
It's going to be interesting to see how the Justice Department proceeds on this, given the fact that they blocked the takeover of Spirit by JetBlue, and they've sort of taken that to court now. So it's going to be interesting to see how the Justice Department responds to this. But there does seem to be a move towards consolidation in the industry, and so depending on where the government goes with this, it will be interesting to see how it plays out.
Hawaiian Holdings right now up 176%. Alaska Air right now down about 15%. A major shipping company is looking to boost its operations in Asia. Bloomberg's Steve Potisk has that story.
UPS has an agreement with the Hong Kong Airport Authority to establish a new fully automated shipping hub at the Hong Kong International Airport. The Atlanta-based package delivery giant says it will serve as its main facility in the region for processing and sorting imports, exports, and transshipments to and from Europe, the U.S., and other parts of Asia, designed to handle close to 1 million tons of annual capacity.
UPS right now up about 0.5%. And sticking with China, Variety is reporting Taylor Swift's Eras Tour movie could be headed there this month or early next month. It's reportedly being reviewed by Chinese authorities. Alibaba Pictures is among the companies set to be handling the import and distribution. And Wanda Films, the previously majority owner of AMC Theaters, is on board as an expedition partner. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.